I am an eager reader of whatever Phil has to say, and I recommend him to you. By Warren Buffett. This book is dedicated to all investors, large and small, who do not adhere to the philosophy, "I have already made up my mind, don't confuse me with facts." There are certain books that have redefined the way we look at the world of finance and investing, books that every investor must read. Philip A. Fisher will introduce you to these memorable books, which are as relevant and important today as they were when they were first published. Open Common Stocks and Uncommon Profits and Other Writings, and rediscover proven strategies, market philosophies, and surefire techniques that stand the test of time. Common Stocks and Uncommon Profits and Other Writings is divided into 3 parts. All 3 parts have made very significant contributions to the world of investing. Part 1, Common Stocks and Uncommon Profits. Part 2, Conservative Investors Sleep Well. Part 3, Developing an Investment Philosophy. I appreciate you choosing this book. Before beginning, I would like to share something special. Kenneth L. Fisher mentioned the greatness of his father, Philip A. Fisher, who is the author of this book, What I Learned from Others' Writings. This book has a way of growing on you. It certainly did for me. It took me about 15 years to truly grasp the insights of common stocks and uncommon profits. When I first picked it up, I was just 8 years old, and frankly, it made very little sense. At that age, it felt like a waste of a perfectly good summer vacation. The book was filled with big words that constantly had me reaching for the dictionary. Ugh! But it was my father's book, and I was immensely proud of him. At school, from neighbors, and in the local paper, I heard that his book was making waves. I learned it was the first investment book ever to make the New York Times bestseller list, whatever that meant. Feeling it was my duty, I trudged through it. And when I finally finished, I was just relieved to have my summer back. Little did I know that I would one day go on to found a major investment management firm serving thousands of clients, write my own books, and become the 6th longest-running columnist in Forbes magazine's storied history. I would also go on to write numerous annual Best of the Year investment book reviews and recommend dozens of books to eager readers. And yes, perhaps it didn't hurt to be able to say I read my first investment book at 8, even if I didn't understand it at the time. The book resurfaced in my life at 20, as I approached college graduation. My father had offered me a job working with him and my older brother. Anxious but skeptical, I wanted to see if there's a real opportunity. So I read Common Stocks and Uncommon Profits again. This time, only a few words tripped me up. As I delved into my father's 15 points for evaluating a stock, I wondered if I could apply them to a local company. If I could, it would validate the value of working with my father. But things didn't go as planned. I identified a local publicly traded lumber company, Pacific Lumber, which seemed promising. However, the few people I approached weren't impressed with a kid trying to gather competitive information without a clear understanding of what to do with it. I struggled to ask meaningful questions, and after several rejections, I gave up. This experience underscored how much I still had to learn. Working for my father was a rocky journey, reminiscent of my first professional stock purchase, a reverse 10-bagger, dropping from 10 to 1. I share this to show that even a young person in their 20s, who wasn't a top student, didn't attend a prestigious university, and had no major achievements to boast about, can learn to effectively apply the principles in this book. And so can you. The 15 points. When you're just starting out in the investment world as I was, figuring out what to buy feels far more urgent than figuring out what to sell. Thankfully, this book teaches that if you choose the right stocks to buy, selling becomes much less of a priority because you can hold on to them longer. And these choices stem directly from my father's 15 points. Applying his 15 points became a hands-on, repeatable process tied to what he called scuttlebutt, a term he used for gathering real-world information about a company by talking to people who know it best. It was a matter of investigating one stock here, another there, and it worked. I won't list all my early career successes here, but I gained tremendous momentum by discovering a handful of great stocks that paid off handsomely. Through these 15 points, I could gauge a company's place in the world and predict its potential successes or challenges. I soon realized why my initial attempt in college to apply these points failed. The skill lies in the scuttlebutt, which, like any craft, takes time to master. Scuttlebutt involves getting insights from real, Main Street sources to determine if a company is strong or weak, avoiding the typical reliance on local gossip and Wall Street noise designed to sell products. As the 21st century dawned, the value of scuttlebutt should have been clear to everyone. But it wasn't. Applying the 15 points with information from Main Street rather than Wall Street would have steered you clear of the infamous scandal stocks of the 2000-2002 bear market, such as Enron, Tyco, and WorldCom. Those who fell for these stocks relied on rumors and Wall Street opinions, rather than on verifying the business's strengths through direct, grounded sources. The 15 points focus on fundamental business features that can't be faked. Scuttlebutt means seeking information from competitors, customers, and suppliers who have vested interests in the company and little reason to see it unrealistically. It means talking to competitors' sales representatives, research teams, and management who, if they respect or even fear the target company, indicate its strength and reliability. Scuttlebutt itself is an art form that brings the 15 points to life. It's like learning to play the piano, craft, and then composing music, art. Art takes time to master. While you may appreciate art without being able to create it, mastering the craft can eventually lead you to artistry. This book helps you sense the art of investing, and fortunately, much of it is common sense. The problem is that most people don't realize this common sense can be applied, so they don't try. But Common Stocks and Uncommon Profits shows you how. Consider the 15 points for a moment. Though you haven't read them yet, let me describe them straightforwardly. You'll see how universally desirable these attributes are. You can delve into my father's detailed words and savor them. My father's 15 points are a guide for what to buy. They describe a firm with vast product and market potential, and a management team committed to exploiting that potential beyond the current product generation. This means an effective research team to create future products and a sales force capable of overcoming obstacles to bring these products to market. It involves profitability, combining gross profit margins and the ratio of gross profits to administrative costs to sustain and grow the business. It also means having a concrete plan to maintain and improve profitability with loyal and productive employees at all levels. Additionally, the company needs excellent cost controls and a unique aspect that allows it to excel within its industry. All of this must be managed by an open, articulate leadership with unquestionable integrity. Reflect on the scandal stocks and overvalued portfolios. None could have passed the scuttlebutt test because competitors didn't fear them, customers weren't impressed, and vendors weren't enthusiastic about their sales volumes. Scuttlebutt ensures you avoid firms that are all hype with no substance. The 15 points not only would have excluded all the scandal stocks of the 2000 to 2002 bear market, but also the so-called 95% club. The tech stocks that lost 95% or more of their value because they were built on hype without real substance. Many internet stocks had no real sales force, no profit margin, no plan for profitability, no fundamental research, and no ability to survive without future financing. They wouldn't have made it past half of the 15 points. The 15 points, by excluding unsuitable companies, would have guided you toward real, sustainable firms, regardless of market trends. In essence, my father's 15 points offer a timeless guide to navigating the investment landscape, helping you identify solid companies that can withstand market volatility and deliver long-term value. Whether you prefer growth stocks, value stocks, small stocks, or large ones. Goals versus scuttlebutt. My father's goals and mine were never quite the same, yet this book works for both of us, and it can work for you too. My father was almost always a growth stock investor. It was simply who he was. In my youth, for various reasons, I was more of a value guy. Nowadays, I'm neither strictly value nor growth, neither big cap nor small cap. I go whichever way the wind blows, but but that's a story for another time. Back then, as a young value investor, the 15 points served me well, guiding me toward high-quality firms with undervalued stocks that did spectacularly well as businesses, but were overlooked by the market in the mid-1970s. My father sought stocks in firms that could grow and grow, ones he could buy at a reasonable price and virtually never sell. I, on the other hand, wanted dirt-cheap stocks of great firms with bad Wall Street images, stocks that could grow fundamentally and be sold at a premium in 5 to 10 years. The beauty of the 15 points in Scuttlebutt is their versatility. They work for growth stocks or value stocks, for big caps or small caps. Take point 4, for instance, an above-average sales organization. It's crucial for a value firm lacking natural sales momentum, for a small firm wanting to compete with larger rivals, and even for a huge firm fending off numerous venture capital-backed competitors. Similarly, point 5 about a worthwhile profit margin is essential. In a commodity-type business with little natural growth, market share, production costs, and long-term profit margins are tightly linked. Good management gains market share and lowers production costs, often through innovative technology. Bad management lowers margins until they disappear. For example, in 1976, I discovered Nucor, a tiny low-cost steel vendor with great management, innovative technology, lower production costs, high relative market share in tiny steel niches, and a growing market presence. I bought it as a value guy, and my father followed me, buying it as a growth guy. We both used the same 15 points. I sold a few years later at a huge profit. My father held it for decades, selling at a much larger profit when Nucor had become the second largest U.S. steel manufacturer. My father, an eclectic genius and already very successful by the time this book came out when he was 51, might not have realized how much time it would take for a novice to learn the craft and turn it into an art. He often thought differently than how he initially explained things. Now at 52, nearly the same age he was when he wrote this, I know that learning the process takes time. I'm more linear and introspective than my father, and I urge you to read this book multiple times throughout your investment life. Take Scuttlebutt, for example. The Scuttlebutt chapter is only 3 pages long, but they are among the book's most important pages. My father might have skipped some of the craft details that he assumed were understood. Over the years, I applied this process to many stocks, gaining valuable insights. The key is focusing on customers, competitors, and suppliers. I described this craft in my first book, Super Stocks, Dow Jones-Irwin, 1984, which included real-world examples. Though it was the best-selling stock market book of 1984 to 1985, it wasn't nearly as timeless as Common Stocks and Uncommon Profits. My book was mostly about craft, not art. With craft, you ask questions and get answers. The art is in generating more questions, and the right questions, from the answers you receive. Some people rigidly follow a standard question list regardless of responses, but that isn't art. Art is when you ask a question, receive an answer, and then know the next best question to ask based on that answer. That makes you a composer, an artist, a creative and investigative investor. This was my father's forte in his prime. Between 1972 and 1982, I accompanied my father on countless company visits. He always prepared questions in advance, typed on yellow pages with space for notes, using them as an outline. His best questions, however, were spontaneous, arising from the answers to lesser questions. Those creative questions were his art. One of the best questions my father asked, which I learned about later from James Michaels, was, "What are you doing that your competitors aren't doing yet?" This question was brilliant. Most people, when asked this, realize they aren't doing anything their competitors aren't already doing. The firm that constantly asks itself this question never becomes complacent. It drives the market, forces competitors to follow, and ensures a better future for its customers, employees, and shareholders. James Walker Michaels, the Dean of U.S. Business Journalism, edited my Forbes columns personally for 15 years. He admired my father greatly. Once, Michaels and I had a weekend together on the West Coast, and he hoped to meet my father, who was then almost 89. They met for a few hours, and on our drive afterward, Michaels kept asking about that question. Eventually, he remembered, What are you doing that your competitors aren't doing yet? This question summed up my father's lifelong aspirations and encapsulated the essence of his 15 points. My firm has applied the 15 points and scuttlebutt to various types of firms, primarily smaller, undervalued ones, including retailers, technology companies, service firms, and more. While the 15 points weren't always the decisive factor, they often added value. We mass-produced the process for many years through a system called 12 Call, using remote workers to interview customers, competitors, and suppliers. Today, we use different technologies, but the principles remain. My firm now manages many billions of dollars, targeting various goals and buying stocks worldwide with over 500 employees. You probably aren't doing that, and you shouldn't do what I'm doing. If you're an individual investor, all 15 points still apply. Use them as I did when I was young, without the resources I have now. The 15 points are valuable whether used exactly as my father envisioned or in a more superficial, broad-spectrum way. For domestic or foreign stocks, for growth or value, or even if you're buying private businesses. The same principles apply. Much more available. Now, don't think for a moment that the only valuable parts of common stocks and uncommon profits are the scuttlebutt and the 15 points. While they might be the crown jewels, there are plenty of other gems hidden within its pages. Timeless bits of wisdom that have been polished by years of experience. Take, for example, a personal anecdote from 1990. By then, I'd been in the business for 18 years, had tasted a fair bit of success, and had been a Forbes columnist for 6. Then Saddam Hussein entered the scene, and with him came the looming threat of war. As tensions rose, investors grew skittish, and the market began to tremble. Drawing on my historical knowledge and financial expertise, I felt it was a time to buy, despite the fear. Yet I hadn't lived through that much history personally. So one weekend, I turned to Chapter 8, 5 Don'ts for Investors, and Chapter 9, 5 More Don'ts for Investors. Those chapters reinforced my belief that the war scare presented a buying opportunity. This conviction led to my well-timed late 1990 buy columns, securing my long-term place at Forbes, for which I've always been grateful. Fast forward to 2002, amidst the worst bear market since the Great Depression, or perhaps since my early career in 1974. Many investors saw their beliefs crumble and turned to new, ultimately hollow investment strategies. My father would have remained steadfast, confident that capitalism and the Western world would prevail. He would have advised owning companies that met his 15 points and avoiding fads. He would have seen this bear market as an opportunity to buy quality firms at reduced prices, knowing they would eventually recover. Would he have feared modern threats like Saddam Hussein, Osama bin Laden, or terrorists? Not at all. Would he have been concerned about war, corporate scandals, or high market price-earnings ratios? Hardly. Instead, he would have focused on the fundamentals of the companies he owned, considering if they still met his criteria or if there were better opportunities elsewhere. Down markets were, to him, a chance to upgrade his portfolio, while others panicked over market fluctuations. Throughout my career, people often compared my actions to what they thought my father would have done. They frequently misjudged his approach, not knowing him as I did. Even as someone deeply familiar with his work, I find it valuable to revisit his writings repeatedly. They serve as an investing Bible, meant to be read multiple times and continually offering new insights. There's a wealth of wisdom in common stocks and uncommon profits, beyond the scuttlebutt and the 15 points. This book is fundamental to investment training, having shaped many leading investors, including Warren Buffett. My father's principles, such as avoiding overstressing diversification, laid the groundwork for many successful investment strategies. Though his later works, like Conservative Investors Sleep Well, added to his legacy, it's his first book that stands out as the definitive guide. In it, he expertly analyzed companies like Motorola, predicting their long-term success, a prediction that proved remarkably accurate. This kind of foresight, rooted in understanding and patience, is rare and invaluable. For those serious about investing, my father's writings are essential. They offer a timeless guide that, revisited throughout one's investing life, reveals deeper layers of wisdom each time. While I fondly remember my father for his bedtime stories rather than stock tips, his professional advice, distilled into one sentence, would be, read his writings and try to live them out. Enjoy exploring the profound insights within these pages, and let them guide you towards a successful investment journey. Introduction. Kenneth L. Fisher. This book stands tall among the most cherished investment tomes of all time. It's a classic, a bestseller, and now it's celebrating 45 years of guiding investors. My father penned the original preface back in September 1957, at our childhood home. That preface remains untouched within these pages. Now, 45 years later, in October 2002, from my current home, I find myself daring to write the first new preface this book has seen in all these decades. If you've read my revised preface, you might assume my father has passed away. That's not the case. As I write, he is 95 and very much alive, though sadly diminished by the ravages of late-stage senile dementia, possibly Alzheimer's disease, though there is no definitive way to diagnose. He lies in bed at home, just 30 feet away from where he once wrote Common Stocks and Uncommon Profits and his other works. His decline is relentless. To those of us caring for him, it seems alarmingly swift. By the time you read this, he may well have passed. He will never read these words. If they were read to him, he couldn't follow the meaning for more than a sentence or two before the thread is lost in the haze of his illness. He was a great man, now reduced to a frail, elderly figure, but he is still my father. This disease, cruel as it is simply that, a disease, not a personal failing. When I wrote my third book, which featured 100 cameo biographies of deceased pioneers of American finance, I chose only those who had passed, primarily because the dead don't sue if you get something wrong. But also, I purposely avoided covering my father. I didn't want to risk misinterpreting him in ways that might hurt him. Now, that concern no longer holds weight because he won't be aware of what I write here. So, it is time to share a bit about the man who wrote one of the most beloved investment books of all time. I am uniquely qualified for this task as I know him intimately through both business and personal lenses. Certainly my mother, his wife, knew him better than anyone on a personal level. My aunt, his sister, knew him longer than anyone. Their relationships were deeply personal, not business-oriented. Yes, I have an elder brother, Arthur, who worked closely with our father for a brief period and was once my business partner. Arthur and I share a close bond. However, his professional interaction with our father was relatively short-lived. Arthur pursued a career in academic humanities, where he remains today. Father always had a special fondness for Arthur, and their emotional connection was profound. Yet, Arthur himself would acknowledge that I spent significantly more business time with our father over many more years, maintaining a daily relationship that Arthur couldn't, partly because Arthur lived 1,000 miles away. My paternal ancestors were Jewish, hailing from Prague, Czechoslovakia, and Germany, arriving in San Francisco in the early 1850s. My father's paternal grandfather, Philip Isaac Fisher, was Levi Strauss's original accountant and managed Strauss's first store. Although not wealthy, he was financially comfortable at his death. His eldest daughter, Caroline, Carrie, took on a significant caregiving role after their mother's early death. My grandfather, Arthur Lawrence Fisher, the youngest of 8, adored Carrie, who acted as a surrogate mother. Arthur Lawrence Fisher, born in 1875 in San Francisco, graduated from UC Berkeley and Johns Hopkins Medical School in 1900. Returning to San Francisco, he practiced general medicine before specializing in orthopedics, becoming the third orthopedic surgeon west of the Mississippi and a founding member of the Western Orthopedics Society. Philip Isaac Fisher's death in 1906 temporarily delayed Arthur's marriage to Eugenia Samuels, further postponed by the infamous 1906 earthquake and fire. They married, and my father was born on September 8, 1907, named Philip Isaac Fisher after his grandfather. In 1911, my father's sister Caroline, named after Aunt Carrie, was born. Carrie, who had married a Levi Strauss relative named Henry Saline, played a crucial role in our family, secretly funding my father's education and providing a car that was pivotal in his career. She also offered emotional and social support to my father, which he deeply needed. My paternal grandfather was not driven by money. He did extensive charity work and academic medicine, often treating patients who couldn't pay. Known for his kind and generous nature, he relied on Aunt Carrie's secret financial support. Without her, my father's education and ultimately this book might never have existed. Father was privately tutored before attending San Francisco's prestigious Lowell High School, graduating at 16. Although intelligent and well-educated, he was socially awkward and physically frail. He started at UC Berkeley and later transferred to Stanford University with financial help from Aunt Carrie, who also provided a car, making his commute easier. Weekly family dinners at Aunt Carrie and Uncle Henry's mansion on Jackson Street were vital in developing my father's social skills. These dinners, which lasted for almost 50 years, were a family tradition and a significant social training ground for my father. Stanford University was a haven for my father. He stayed on for the newly established Graduate School of Business, again secretly funded by Aunt Carrie. At Stanford, he took a class that involved visiting and analyzing local businesses, which profoundly impacted him, especially the time spent driving the professor, Boris Emmett. My father credited these car rides with Emmett as more educational than all his other time at Stanford combined. My father's early business experiences are well documented in his writings, particularly in his 1980 Financial Analysts Research Foundation monograph, Developing an Investment Philosophy, and his original preface to Common Stocks and Uncommon Profits. Therefore, I won't delve into those details here. Middle life. As World War II progressed, my father put his business on hold and enlisted. He was fortunate. His mentor, Ed Heller, had enlisted earlier and managed to get my father an officer position. This kept him off the front lines, working in accounting and finance for the Army Air Corps. On his first day as a lieutenant, he struggled with the formalities of military life. Despite being treated well, he disliked the regimentation and lack of freedom. In Little Rock, Arkansas, he met my mother, Dorothy White. They quickly fell in love and married. In 1944, my eldest brother, Arthur, was born in San Francisco, where my mother had moved for medical supervision. Donald was born in 1947, and I followed in 1950. Tragically, a daughter died in childbirth between Donald and me. Shortly after my birth, my parents bought a house in San Mateo, California. They loved the acre it sat on, but disliked the house itself. My father tore it down and built a new, larger, and more austere home, where everything had to be perfectly neat. He loved the yard and spent weekends tending to it, finding solace from his worries. The late 1950s and 1960s were the peak of my father's life. In 1958, he published Common Stocks and Uncommon Profits, which made him a national star and a key figure in the San Francisco investment community. His fame allowed him to maintain a small, select client base without needing a large organization, fitting his private and socially awkward nature. In 1945, Herbert Dougal hired my father to teach Stanford's first dedicated investment course during Dougal's sabbatical. My father loved teaching and returned occasionally to lecture, even in his later years when dementia had set in. His student, Jack McDonald, was inspired by my father and continued the course, making it a testament to my father's influence. As dementia took hold, my father slowly forgot recent acquaintances but retained memories of earlier relationships. By the 1960s, he preferred a quiet life, rarely making public appearances. In 1970, my brother Arthur joined my father's business, and I joined 2 years later. However, my father's inability to delegate led to tensions, and eventually both Arthur and I left the business. In his later years, my father reduced his stock holdings to a few high-quality ones. Despite his earlier success, his later investment decisions were poorly timed. He believed that stopping work would lead to his decline, so he pushed himself to continue working, even as dementia progressed. In 1999, I moved his office to his home, but by 2000, he had to give up working entirely. He attempted to write another book, but could only manage a few pages. His career spanned 72 years, and its end left him deeply depressed, highlighting how closely his identity was tied to his work. What kind of man? Father was sparse and Spartan, serious with a quirky sense of humor. He adored puns, referring to anyone else's as two-thirds of a pun, or pew. As a child, my friends were terrified of him due to his unintentional cold stare that seemed to pierce right through you. Dark-haired, dark-complexioned, and almost gaunt, he had an intimidating presence, often dressed in dark clothes. Had he been born 20 years later and 75 years earlier, he could have easily been the archetypal thin, dark-haired, dark-dressed gunslinger from westerns, fantasized to say, "Just one move and I'll plug you." But he never plugged anyone. He wasn't mean, just looked mean. Children tiptoed around him, scooting fast to avoid his presence. He never praised anyone except my oldest brother, whom he adored from birth. Despite his tough exterior, I knew he held me in high regard, though he rarely showed it directly. It wasn't until I was well into my 40s that he finally praised me, albeit in his own roundabout way. His career was marked by a unique methodology for finding new stock ideas. Decades before computer screening, he allowed any young investment man to set an appointment to discuss investments. Usually, he wouldn't see the man again unless he deemed him unusually capable. Then he would engage in an ongoing exchange of ideas. He was so precise and focused that in his entire career, he only followed one man into a stock once and two individuals twice. The only person he ever followed 3 times was me, adopting 3 of my stock ideas and making more than 1,000% on each. Despite this, he rarely acknowledged my contributions directly, except for one instance when I was in my 40s. Even then, his acknowledgement was limited and followed by an argument about who had the final say in picking successful ideas. Father's daily grind was equally regimented. In 1958, as Common Stocks and Uncommon Profits was published, he arrived home from work, changed clothes, ate dinner formally, and then retired to the living room to read. Sometimes business materials, but usually murder mysteries until bedtime. He told my brothers and me bedtime stories, lavishing more attention on me because I enjoyed them more. His stories ranged from non-fiction history to fiction of his own creation, and they were all great. He drove us kids to school at 7:30 in a beat-up blue Oldsmobile, then walked to the train station and rode into San Francisco, reading business materials on the train. At his office in Mills Tower, he remained solitary, rarely working long hours or frantically, yet achieving remarkable success due to his focused genius. He had 2 offices over the years, with the furniture never changing. His luxury was the view of San Francisco Bay, which faded as taller buildings obstructed it by the mid-1980s. He walked the mile back to the train station each night, read on the way home, and preferred solitude, only socializing minimally. He loved election returns, memorizing all 435 House members and 100 senators, reciting them to fall asleep. His passion for elections linked to his interest in politics, where he categorized races into groups by region and watched the closest ones like a hawk. Despite his detachment from most new techniques after age 50, he had a curious blend of habit and intellect that defined his personal and professional life. Father was frugal, sometimes making me share a hotel room with him, even when I could afford my own. At a technology stock conference in Monterey, he exhibited his strategic thinking by winning a dinner contest predicting the Dow's movement, not by guessing accurately, but by aiming high, creating the impression of insider knowledge. This blend of showmanship and solitary discipline encapsulated who he was: cool, cold, hard, tough, disciplined, non-social, ever confident externally, but often scared internally. An amazing man who respected those closest to him, but struggled to communicate it directly. My father had 3 passions: walking, worrying, and work. These pursuits defined him more than anything else. He never truly relaxed like most people. Instead, he channeled his restless energy into worrying about anything and everything. To him, worry was a way of controlling risk, a method to ensure nothing bad could ever happen. He would fret incessantly, a trait that often clashed with my more carefree approach to decision-making. "Ken, I wish you would run scared more often," he would say, admiring his own anxious nature while failing to understand my preference for a more measured approach. In the garden, he found solace in worrying. It was his way of ensuring he left no stone unturned, which may have prevented mistakes but also limited his potential for greater financial success. Despite this, walking was his true release. Whether in the city or the woods, walking helped him shed his worries and find peace. He walked to work and back every day, savoring the tranquility of San Mateo's gardens and avoiding the perils of downtown San Francisco. A memorable moment came when I was 14, during a Wyoming dude ranch vacation. Amidst a violent storm, Father and I ran through hail and lightning, his laughter breaking the tension. His resilience was remarkable, keeping pace with me despite his age. Later in life, after a series of unfortunate events, including a broken hip, his health declined. Dementia set in, clouding his memory and diminishing his independence. Now bedridden and unable to engage in his favorite activities, my father has become a shadow of the man he once was. My mother, despite her tireless care, struggles with the burden. The man I knew is long gone, replaced by a frail figure who clings to a few familiar faces. Despite having 11 grandchildren and 4 great-grandchildren, only a few truly understand the man he was. The rest see only a reflection of a past they can barely comprehend. Significance. The mirror image. My father was a remarkable man whose influence stretched far and wide, touching everyone from national business leaders to students and beyond. He had a rare gift for reflecting ideas back to people in a way that made them believe those ideas originated with themselves. It was as if he was a mirror for the mind. Over the decades, countless individuals have recounted how a brief encounter with him, or a single phrase he spoke, sparked ideas that led to their own successes. They often attribute their breakthroughs to his influence, even though, in many cases, he never said exactly what they remember. His ability to reflect people's thoughts and ignite their creativity was a testament to his unique way of interacting with others. His writings, like Common Stocks and Uncommon Profits and Conservative Investors Sleep Well, continue this legacy. Many investors claim that his books inspired their strategies, even if the actual ideas stemmed from within themselves. The real magic lies in how his words act as a mirror, helping readers see and think in ways they might not have otherwise. 45 years after his seminal work was published, his direct influence may have waned, but his writings endure. If you're encountering his work for the first time or returning to it, you're engaging with a man who, through his words and ideas, remains a reflective mirror for many. His legacy will continue to inspire, just as his memory remains vivid for me. Preface. The publication of a new book on investment often demands an explanation from its author. Allow me to share a personal story that illuminates why I felt compelled to add another volume to this field. After completing a year at Stanford University's fledgling Graduate School of Business Administration, I ventured into the business world in May 1928. I joined the statistical department of what is now the Crocker Anglo National Bank of San Francisco, and quickly rose to head the department. In today's terms, I would be known as a security analyst. From this vantage point, I witnessed the extravagant financial excesses that culminated in the 1929 crash and the harsh aftermath that followed. These experiences convinced me that there was a unique opportunity on the West Coast for an investment counseling firm dedicated to true value, not just market prices. On March 1st, 1931, I founded Fisher & Co., focusing on investment counseling with a keen interest in a few growth companies. The business thrived until World War II interrupted, and I found myself working various desk jobs for the Army Air Force. During this time, I reflected on both successful and failed investments I had seen over the past decade, leading me to identify new investment principles that deviated from conventional wisdom. Upon returning to civilian life, I was determined to implement these principles without distraction. Fisher & Co. narrowed its focus to a select few clients, never more than a dozen at a time, and concentrated on major capital appreciation. Despite the post-war market's general rise, our consistent outperformance of market indices validated these principles even during static or declining periods. Two key insights influenced my decision to write this book: the necessity of patience for significant investment gains, and the deceptive nature of the stock market, where following the crowd often leads to poor decisions. Over the years, I found myself explaining these principles in detail to my clients to prevent premature sell-offs of unfamiliar yet promising securities. This need for a comprehensive explanation inspired me to compile these investment principles into a book. I envisioned it as an informal guide, addressing you, the reader, in the first person, using the same language, examples, and analogies I shared with my clients. I hope my frankness and occasional bluntness won't offend. More importantly, I hope the value of the ideas presented outweighs any shortcomings in my writing. Philip A. Fisher, San Mateo, California, September 1957. Part 1. Common Stocks and Uncommon Profits. Chapter 1. Clues from the Past. Imagine you have some money saved up and you're thinking about buying common stock. Maybe you're seeking higher income than other investments could offer, hoping to grow alongside America. You might dream of discovering the next Ford or Mellon, laying the groundwork for a future fortune. Or perhaps you're more cautious, wanting a safe nest egg protected against inflation. Whatever your reasons, your goal is clear: to make money. Before diving into the stock market, it's crucial to understand how fortunes have been made historically. Looking back, we see two main strategies: betting on the business cycle and investing in outstanding companies for the long haul. In the 19th and early 20th centuries, many fortunes were made by capitalizing on the boom and bust cycles caused by an unstable banking system. Buying stocks during downturns and selling during upswings was profitable, especially for those with insider knowledge. However, a more effective and less risky method emerged: finding exceptional companies and holding onto them through market fluctuations. This might seem surprising, but it's backed by history. Many companies listed on stock exchanges today have offered incredible returns over the past 25 to 50 years. Investing $10,000 in these companies could have grown to $250,000 or more. These opportunities didn't require perfect timing, just the ability to identify outstanding companies among the rest. Are such opportunities available today? Absolutely. In fact, the prospects are even better. One reason is the shift in corporate management. A generation ago, corporations were often family-owned, with little regard for outside shareholders. Today, corporate management is more professional and focused on efficiency and innovation. The growth of corporate research and development has been transformative. In the late 1920s, only a few companies had significant research organizations. Today, research and development expenditures are skyrocketing, leading to new products and opportunities. Companies expect a significant portion of future sales to come from products not yet in existence, underscoring the importance of innovation. Government policies also play a role. Since the 1930s, both major political parties have been committed to using deficit spending to combat economic downturns. This approach, combined with inflationary pressures, means that economic downturns are likely to be shorter and followed by inflation, benefiting strong growth companies. Given this backdrop, high-grade bonds have become less attractive for long-term investors due to their susceptibility to inflation. The decline in purchasing power of money over time has made bonds a less secure investment compared to stocks, which can offer better protection against inflation. In summary, the greatest investment rewards come from finding companies that can grow significantly over time and sticking with them. These companies often excel in research and development and are managed by teams focused on both long-term growth and day-to-day excellence. Despite the challenges of the past, today's investment opportunities are likely even more abundant, offering savvy investors the chance to achieve substantial gains. Part 1. Common Stocks and Uncommon Profits. Chapter 2. What Scuttlebutt Can Do. Imagine you've got some savings and you're eager to invest in common stocks. You're hunting for that one company that could transform your modest investment into a small fortune. But where do you begin? A logical yet impractical method is to find someone highly skilled in management to thoroughly investigate a company's operations, from its executives to its sales, production, and research. However, such experts are rare, often busy with their high-paying jobs, and companies aren't likely to divulge sensitive information to outsiders. Fortunately, there's a more accessible method called the scuttlebutt approach. This strategy involves gathering insights from those who interact with the company, providing clues about its potential for growth. Here's how it works. Tapping the grapevine. Industry opinions. Speak to multiple companies within the industry. By asking each one about the other's strengths and weaknesses, you'll build a surprisingly accurate picture. Vendors and customers. These stakeholders often reveal a lot about a company's performance and the people running it. Research scientists and trade associations. Experts from universities, government, and trade groups can provide valuable insights. Ensuring confidentiality. To get honest opinions, it's crucial to assure sources their information will remain confidential. Maintaining this trust is vital to avoid deterring informants from sharing candid feedback. Former employees. Inside scoop. Former employees often provide a deep understanding of a company's strengths and weaknesses. Check for bias. Always cross-check their information, as some may hold grudges or have left under negative circumstances. Piecing it all together. Collecting diverse opinions will yield varied insights. The key is to look for a predominant trend that stands out clearly. This approach helps even moderately experienced investors identify companies worth further investigation. Next steps. Once you have a solid understanding from your scuttlebutt research, contact the company's officers to fill in any remaining gaps. This comprehensive approach increases your chances of finding a true gem in the stock market. The scuttlebutt method might seem daunting at first, but with practice, it becomes an invaluable tool in identifying promising investment opportunities. So, get out there and start talking. Your next great investment could be just a conversation away. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. When looking to make a stellar investment, one that could potentially yield several 100% in a few years or a correspondingly greater increase over a longer period, what should an investor focus on? What attributes must a company possess to ensure the highest likelihood of such extraordinary results for its shareholders? There are 15 key points an investor should consider. While a company might still be a lucrative investment if it fails to fully meet a few of these points, it would struggle to meet the definition of a worthwhile investment if it falls short on many. These points cover both company policies and the efficiency of their implementation. Some aspects require external research, while others are best understood through direct inquiry with the company. Here are the 15 points. Point 1. Does the company offer products or services with sufficient market potential to enable a substantial increase in sales over several years? It's not impossible to make a profit from companies with stagnant or even declining sales. Operational efficiencies and better cost control can sometimes drive enough improvement in net income to boost the market price of a company's shares. However, this type of one-time profit doesn't offer the same opportunity as investing in a company poised for significant long-term growth. Consider two scenarios. One where a company experiences a brief surge in sales due to a one-time event, and another where a company sees steady, substantial growth over an extended period. The latter is the type of company that offers the greatest potential for investors seeking significant gains. For instance, the surge in sales experienced by radio set manufacturers with the advent of television was temporary. Once most homes had television sets, the sales growth plateaued. This initial boom, followed by stagnation, highlights the importance of finding companies with sustained growth potential. Not even the most outstanding growth companies show increased sales every single year. Sales growth often comes in irregular spurts due to the complexities of commercial research and the challenges of marketing new products. The business cycle also affects year-to-year comparisons, so growth should be evaluated over several years. Companies that consistently demonstrate spectacular growth over decades can be categorized into two groups: the fortunate and able, and the fortunate because they are able. Fortunate and able. Aluminum Company of America, Alcoa. Alcoa's founders had great vision, foreseeing significant commercial uses for aluminum. Although they couldn't have predicted the full market potential that would develop over 70 years, a combination of technical developments and external factors fueled the company's growth. Alcoa's management skillfully took advantage of these trends, showing a high order of business acumen. However, if background conditions hadn't been favorable, the company would have grown at a slower rate. The company's success wasn't just due to luck. It required ongoing high-level management to capitalize on opportunities and fend off competitors. Fortunate because they are able. DuPont. Unlike Alcoa, DuPont didn't start with its now famous products like nylon, cellophane, and neoprene. Initially, DuPont made blasting powder. Over time, the company's brilliant business and financial judgment, combined with superb technical skill, led to the development of a wide range of highly profitable products. DuPont's story illustrates how companies can achieve spectacular growth through ingenuity and resourcefulness, even in industries that initially seem to offer limited prospects. Another example, General American Transportation. Formed over 50 years ago, General American Transportation initially appeared to have ample growth prospects in the railroad equipment industry. When the outlook for railroads became less appealing, the company's management displayed ingenuity by diversifying into other lines of business, maintaining steady growth despite industry challenges. Sales growth and management quality. A company with promising long-term sales growth can be a bonanza for investors, regardless of whether it is fortunate and able or fortunate because it is able. However, sustained growth requires outstanding management. Without high-caliber management, even companies with strong initial prospects may falter. Superficial judgments and long-term growth. Superficial judgments can lead to incorrect conclusions about a company's growth potential. For instance, radio/television stocks initially showed one-time growth as homes acquired television sets. However, some companies in this sector later capitalized on their electronic skills to expand into other fields, such as communication and automation equipment, leading to sustained growth. Companies like Motorola exemplify how alert management can drive upward sales curves through technological advancements and diversification. In conclusion, investors should stay vigilant for opportunities where management can leverage technological changes to drive future growth. While specific outcomes are uncertain, the ability of a company's management to navigate and capitalize on industry trends is crucial. This vigilance can lead to highly profitable investments, as demonstrated by companies like Motorola and Corning Glass Works, which adapted and thrived in evolving markets. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 2. The pursuit of continuous innovation. Does the management have a relentless drive to continually develop new products or processes to expand total sales potential, even when the current product lines have largely been tapped out? Here's the deal. A company might be riding high on the back of a hot new product or trend, providing impressive growth and a tempting one-time profit. However, if this company lacks a forward-thinking strategy to innovate and develop new products once the current excitement fades, its long-term prospects may be limited. True financial success often comes from consistent gains over many years, not just a fleeting spike. Enter scientific research and development. These are the engines that power ongoing growth, pushing companies beyond initial success to ensure a series of continuous advancements. A management team that is not satisfied with a single growth spurt, but actively seeks to foster a series of incremental advances, will stand out. Ideally, the best companies invest their engineering and research efforts into products that build on their existing lines. Picture this: a company with multiple divisions, each focused on enhancing its own set of products, like a tree sprouting new branches from its trunk. This approach often yields better results than a company dabbling in a range of unrelated new products, which might land it in entirely new industries far removed from its core business. At first glance, Point 2 might seem like a repeat of Point 1, but there's a crucial difference. Point 1 assesses the current growth potential of a company's product lines, while Point 2 delves into management's mindset. It's about whether the company recognizes the need to evolve and expand beyond its current market to sustain growth in the future. The companies that excel in both areas, having robust, current growth potential and a proactive management attitude towards future development are often the ones that offer the most compelling investment opportunities. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 3. Evaluating R&D effectiveness relative to company size. When assessing a company's research and development R&D efforts, it's not just about how much they spend, but how effectively that spending translates to results. Here's a breakdown of how to gauge this. R&D investment versus company size. Evaluate how effectively a company uses its research and development budget relative to its size. Compare R&D spending to annual sales to get an idea of how much is invested per sales dollar. Industry comparisons. Professional analysts often compare a company's R&D spending with others in the same industry or against industry averages. This helps gauge the company's commitment to innovation. Quality over quantity. Raw R&D spending figures can be misleading. Companies may categorize expenses differently, with some including engineering costs that others do not. This can affect the perceived efficiency of their research efforts in results. There can be significant differences in how effectively companies convert R&D spending into valuable outcomes. Some firms achieve double the gains from their research investments compared to others, highlighting the impact of efficient management and skilled teams. Team coordination. Effective research relies not only on individual expertise, but also on how well different specialists work together. A well-coordinated team can significantly enhance research outcomes. Integration with production and sales. Successful R&D also requires close coordination with production and sales teams to ensure new products are manufacturable and market-ready. Poor integration can lead to inefficient production or less appealing products. Top management's role. The effectiveness of R&D can be influenced by top management's understanding of research processes. Misguided, crash programs or inconsistent project support can lead to wasted resources and increased costs. Defense contracts. Research funded by defense contracts often has different economic implications compared to private research. Evaluating the value of such research involves understanding how it impacts future commercial opportunities and whether it translates into profitable non-defense applications. Market research importance. Effective market research bridges the gap between R&D and sales. It helps ensure that research efforts are directed towards products with sufficient market potential to justify the investment. Scuttlebutt method. To get a true picture of a company's R&D effectiveness, consider speaking with a range of informed sources, including employees, competitors, and experts. Additionally, analyzing past contributions of research to sales or profits can offer insights into future potential. By focusing on these aspects, investors can better understand the real impact of a company's R&D efforts and its potential for future growth. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 4. Does the company have an above-average sales organization? In today's competitive world, few companies have products or services so outstanding that they sell themselves. Expert merchandising is essential. Making a sale is the foundation of any business, and securing repeat sales to satisfied customers is the true mark of success. Yet, oddly enough, investors often overlook the efficiency of a company's sales, advertising, and distribution teams, focusing more on production, research, finance, or other areas. Why is this? It's likely because it's easy to create simple ratios to compare production costs, research activities, or financial structures. However, crafting meaningful ratios for sales and distribution efficiency is much harder. Even though ratios for research and other areas may be overly simplistic, investors still prefer them. Since sales efforts don't easily fit into such formulas, they often go unexamined, despite their critical role in determining a company's true investment worth. The solution lies in the scuttlebutt technique, gathering information from sources outside the company. Competitors and customers often have valuable insights into a company's sales organization and are usually willing to share their opinions. For the diligent investor, this approach can yield rich rewards. Sales ability might receive less emphasis than research, but that doesn't mean it's less important. Corporate success today relies on many factors, with production, sales, and research being the three main pillars. Arguing that one is more important than the other is like debating which organ, the heart, lungs, or digestive system, is crucial for the body. All are essential for survival and vigorous health. Companies with strong, aggressive distribution and a continuously improving sales organization often stand out as outstanding investments. Consider Dow Chemical Company, a paragon of long-term conservative investment. Known for its successful research, Dow also meticulously selects and trains its sales personnel. Prospective salespeople undergo rigorous screening and extensive training before they meet their first customer. This training is continuous, reflecting the company's commitment to efficient customer service and delivery. Dow isn't unique in this regard. International Business Machines, IBM, is another example of a company that has richly rewarded its owners. An IBM executive once noted that their salespeople spend a third of their time in company-sponsored training. This intensive training helps the sales force stay updated with rapidly changing technology, emphasizing the importance successful companies place on their sales teams. A company might achieve a one-time profit through exceptional manufacturing or research, but without a strong distribution organization, it remains vulnerable. For sustained, long-term growth, a robust sales arm is indispensable. Look around at the companies that have proven to be outstanding investments. They all have aggressive distribution and constantly improving sales organizations. Part 1, Uncommon Stocks and Uncommon Profits. Chapter 3, What to Buy. Point 5. Does the company have a worthwhile profit margin? Finally, we come to a topic that fits neatly into the type of mathematical analysis many financial experts believe is at the core of sound investment decisions: profit margins. From an investor's perspective, sales only matter if they lead to increased profits. All the sales growth in the world won't make a company a good investment if profits don't grow correspondingly. The first step in examining profits is to study a company's profit margin. How many cents of each dollar of sales turn into operating profit? You'll notice significant variations between companies, even within the same industry. This analysis should cover several years, not just one. Typically, companies have wider profit margins and greater total profits during prosperous years for their industry. However, marginal companies, those with smaller profit margins, often show a greater percentage increase in profits during good years than stronger companies. This happens because weaker companies' profit margins improve more dramatically in good times, but these earnings decline just as quickly when the business climate worsens. For this reason, the greatest long-term investment profits are rarely found in marginal companies. The only time to consider investing in a company with a low profit margin is when there are strong signs of a fundamental change within the company, such as improvements in efficiency or new product developments that suggest the company is no longer truly marginal. When such internal changes are happening in a company that otherwise meets the criteria for a good long-term investment, it might be an unusually attractive purchase. In the case of older and larger companies, most significant investment gains have come from those with relatively broad profit margins, often the best in their industry. Young companies, and occasionally older ones, can be an exception to this rule. They might deliberately choose to reinvest most or all of their profits into research or sales promotion to accelerate growth. In such cases, it's crucial to ensure that this reinvestment is genuinely aimed at future growth, not just maintaining the current level of operations. If a company's narrow profit margin is due to aggressive reinvestment in research, sales promotion, or other growth activities, it might actually be a very attractive investment. However, investors seeking maximum gains over the years should generally avoid companies with low profit margins, unless these low margins are deliberately engineered to accelerate growth. Part 1, Common Stocks and Uncommon Profits. Chapter 3, What to Buy. Point 6. What is the company doing to maintain or improve profit margins? Investing in stocks is not just about understanding a company's current financials. It's about predicting its future performance. This means the future of profit margins is what truly matters to investors. In today's economic landscape, profit margins face ongoing pressure. Rising wages, increasing labor costs, and higher taxes are all part of the picture. Companies that seem to maintain their profit margins by simply raising prices often find this strategy is only a temporary fix. As new competition emerges, it can quickly erode these gains, leading to shrinking margins. A classic example is the aluminum market's abrupt shift in 1956 from short supply to intense competition, which made previously high prices unsustainable. Similarly, some steel producers have resisted raising prices too high to avoid short-lived profit margins. However, some companies go beyond price adjustments to maintain or improve their margins. They invest in capital improvements and product engineering to cut costs. For instance, innovations in equipment, process optimization, and transportation can help offset rising expenses. Companies that constantly seek cost-saving measures and operational efficiencies are better positioned for long-term success. These strategies require significant time and effort, and the most successful companies are those that continuously innovate and plan ahead. Investors should look at how creatively a company is working to improve margins and whether it has a track record of implementing cost-saving measures effectively. Engaging with company personnel directly can provide valuable insights into these efforts, as top executives are often open about their strategies for maintaining or improving profit margins. Companies excelling in this area are likely to offer substantial long-term rewards for shareholders. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 7. Does the company have outstanding labor and personnel relations? Investors often overlook the profound impact of excellent labor relations, focusing instead on the more visible costs of strikes and labor disputes. But the real value lies in recognizing the significant benefits of good personnel relations. Companies with strong labor relations enjoy a more productive workforce, lower turnover rates, and reduced training costs. When employees feel valued and fairly treated, productivity soars and costly turnover is minimized. So, how can an investor gauge the quality of a company's labor relations? There's no one-size-fits-all measure, but several key indicators can help paint a clearer picture. 1. Union presence. In a world where unionization is widespread, companies without unions, or with company unions, often have exceptional labor relations. For example, Motorola and Texas Instruments, despite being in unionized areas, have managed to keep strong, positive relationships with their employees. 2. Unionization is not a negative indicator. Some well-unionized companies maintain excellent relations with their unions, characterized by mutual respect and effective collaboration. Conversely, the absence of strikes doesn't always equate to good labor relations. Sometimes, it's just a sign of fear of conflict, rather than genuine satisfaction. 3. Employee loyalty. High employee loyalty can be gauged by looking at labor turnover rates and the length of job applicant waiting lists. Companies with long lists of eager job seekers often have a reputation for treating their employees well. 4. Grievance resolution. Companies that address and resolve grievances promptly tend to have better labor relations. Persistent unresolved issues can simmer and escalate into more significant conflicts. 5. Wage scales. Firms that pay above average wages while still showing strong profits are likely to have good labor relations. Conversely, companies that keep wages below local standards might face trouble in the future. 6. Management attitude. The true test of labor relations lies in how management treats its rank-and-file employees. Companies with management that values and respects their workers, beyond just avoiding union issues, are more likely to offer solid long-term investment opportunities. In summary, outstanding labor and personnel relations are not just about avoiding strikes or managing unions. They're about creating an environment where employees are valued, which in turn fosters greater productivity and stability. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 8. Does the company have outstanding executive relations? While strong relationships with lower-level staff are crucial, fostering a positive atmosphere among top executives is even more critical. These leaders, whose decisions, innovation, and teamwork drive a company's success, operate under high pressure. If the executive environment is fraught with tension or unresolved conflicts, top talent may either leave or fail to perform at their best. The most promising investment opportunities often lie in companies with a thriving executive climate. Here's what to look for. 1. Confidence in leadership. Executives should have trust in their president or board chairman. This confidence is reflected in a clear belief that promotions are based on merit, not favoritism. 2. Fair promotion practices. A good executive environment ensures that promotions are earned and not based on factionalism or nepotism. Talented individuals should advance regardless of their connections. 3. Regular salary reviews. Executives should feel that their compensation is reviewed regularly and that merit-based raises are the norm. Salaries should be competitive within the industry and locale. 4. Internal promotion. Ideally, top management should look within the company for promotions rather than hiring externally, ensuring that talented individuals are given growth opportunities. 5. Minimized friction. While some degree of interpersonal friction is inevitable, effective management should minimize this to maintain a cooperative and productive environment. Investors can often gauge these factors through casual conversations with executives at various levels. Companies that stray from these practices may not be as strong an investment opportunity. In contrast, those that nurture a supportive executive environment are likely to offer substantial long-term rewards. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 9. Does the company have depth to its management? A small, dynamic company can indeed thrive under the guidance of a brilliant leader, providing a fantastic investment opportunity. However, even the most skilled individual is only human, and the risk of a single point of failure, like the loss of this key figure, can pose a significant threat. Thankfully, with the trend of larger corporations acquiring standout smaller firms, this risk is less daunting. For a company to be a strong, long-term investment, it needs to demonstrate the ability to grow beyond the influence of a single visionary leader. Typically, this shift occurs when a company's sales hit between $15 million and $40 million. At this stage, developing a solid management team becomes crucial. Here's what to consider for a company with promising management depth. 1. Delegation of authority. Effective management depth requires that executives at all levels be granted real authority. Without this, talented individuals may be stifled, unable to fully develop their skills. 2. Avoiding micromanagement. Companies where top executives handle routine details directly may struggle to develop capable future leaders. At a certain size, it becomes impractical for a few individuals to manage every detail effectively. 3. Openness to suggestions. Top management should be receptive to feedback, even if it challenges current practices. A company that welcomes and evaluates new ideas, regardless of their source, is likely to foster a more innovative and adaptable management team. Investors should look for companies that nurture their executives, empower them with authority, and remain open to improvement and innovation. These traits are indicators of a well-rounded, resilient management team capable of sustaining growth and success over the long term. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 10. How good are the company's cost analysis and accounting controls? Imagine a company as a finely tuned machine where every cog and gear must operate smoothly. To keep this machine running at peak performance, the company needs to have an exceptional grasp on its costs. This isn't just about tracking expenses. It's about having a precise understanding of each cost component, down to the finest details. Why is this so critical? Without accurate cost analysis, management struggles to pinpoint which areas need improvement or if they're solving problems effectively. In a company with a diverse product lineup, knowing the true cost of each product is essential. Without this insight, pricing strategies can falter, leading to missed profit opportunities or unintended losses. Essentially, without a clear picture of costs, intelligent planning and decision-making become nearly impossible. In practice, it's rare for investors to get a full view of a company's cost accounting controls unless there's a glaring issue. The scuttlebutt method, gathering informal opinions, might uncover deficiencies, but it rarely provides a comprehensive picture. Direct inquiries might reveal that the company claims its cost data is solid, supported by detailed sheets. Yet, it's not just about having detailed figures, it's about their accuracy and relevance. For most investors, it's challenging to assess the exact quality of a company's cost analysis. However, recognizing that exceptional companies usually excel in cost control, alongside their other business skills, can be a good indicator. If a company demonstrates strong overall business acumen and has management that understands the importance of expert accounting controls, it's likely that its cost analysis is in good shape. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to Buy. Point 11. When diving into the nuances of a business, especially one unique to its industry, an investor can uncover critical insights that set a company apart from its competition. This area of inquiry is broad and varied, as factors that are crucial in one industry might be trivial in another. For instance, in the retail sector, a company's prowess in managing real estate, such as securing favorable leases, can be a game changer. Conversely, this skill might be less critical in other fields. Similarly, a company's ability to handle credit effectively can be vital for some businesses, but negligible for others. Here, our trusty scuttlebutt method can provide a clear picture, often confirmed by comparing metrics like leasing costs per sales dollar or credit loss ratios. In many industries, insurance costs can significantly impact the bottom line. A company that manages to keep these costs 35% lower than a competitor of similar size can enjoy a substantial profit margin advantage. In sectors where insurance costs are pivotal, analyzing these ratios and consulting with knowledgeable insurance professionals can yield valuable insights. Lower insurance costs often reflect a company's overall efficiency in managing people, inventory, and property to minimize accidents, damage, and waste, showcasing strong management. Patents also play a varying role in a company's competitive edge. For large companies, patents usually add strength by reducing competition in specific product areas, leading to higher profit margins. However, patents rarely cover all possible methods of achieving the same result, and many large firms prefer to license their patents to competitors for a fee, relying more on their manufacturing know-how, sales and service capabilities, and customer relationships to maintain their market position. In fact, over-reliance on patents can indicate weakness, as patents eventually expire, potentially harming profits. In contrast, for young companies, especially those with innovative products or services, patents can be crucial. Without them, larger competitors could easily replicate their offerings and leverage their established customer bases to push the smaller company out of the market. For these emerging businesses, it's essential to scrutinize the breadth and enforceability of their patents. Continuous innovation can often provide more significant protection than static patents. Take, for example, a young West Coast electronics manufacturer that found success with a new product. A major industry player created a similar version, but inadvertently included the small company's initial design flaws. Meanwhile, the smaller company launched an improved model, leading the larger competitor to withdraw from the market. This scenario highlights how continuous innovation in engineering can be more protective than patents alone. Therefore, investors should balance recognizing the importance of patents in certain situations with an awareness of the overarching significance of ongoing innovation and operational excellence. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to Buy. Point 12. Does the company focus on short-term or long-term profits? Some companies chase the biggest profits they can grab right now. Others intentionally forego immediate gains to build goodwill, aiming for bigger overall profits in the long run. Their approach to customers and vendors often highlights this difference. One company might drive the hardest bargains with suppliers, squeezing every penny. Another might pay above the contract price to a vendor who faced unexpected costs, ensuring a reliable source of materials or high-quality components when the market tightens and supplies are scarce. The treatment of customers shows a similar contrast. A company that goes out of its way to help a regular customer in a bind might see lower profits on that particular deal, but reap much greater rewards over the years. These policy differences often become clear through the scuttlebutt method. For investors seeking maximum returns, companies with a genuinely long-term profit outlook are the better bet. Part 1. Common stocks and uncommon profits. Chapter 3. What to buy. Point 13. In the foreseeable future, will the growth of the company necessitate significant equity financing, resulting in a larger number of shares that could diminish the benefits current stockholders expect from this anticipated growth? The typical investment book often dwells on a corporation's cash position, corporate structure, and capitalization breakdown. It raises the question, why not give more emphasis to these financial aspects rather than just 1 point out of 15? This book argues that the intelligent investor shouldn't buy common stocks just because they're cheap, but should seek those with the potential for major gains. Few companies score highly on all 14 points discussed. Those that do can easily borrow money at competitive rates, up to the acceptable debt limit for their industry. If such a company needs more cash after reaching this limit, and it excels in sales growth, profit margins, management, research, etc., it can still attract equity investors eager to join promising ventures. For investors focusing on outstanding situations, the crucial factor is whether the company's cash and borrowing ability can cover capital needs for the next few years. If it can, and the company prudently borrows to its limit, long-term equity financing shouldn't concern common stock investors. If the situation is appraised correctly, any future equity financing will likely occur at much higher stock prices, thanks to near-term earnings increases driving up the stock's value. However, if current borrowing power is insufficient, equity financing becomes necessary. In this scenario, the investment's appeal depends on calculating how much the dilution from more outstanding shares will impact the benefits to current stockholders. This dilution is as calculable when it results from issuing senior securities with conversion features as it is from straight common stock. Conversion features typically activate at a slight premium above the market price, usually 10 to 20%. Since investors seek significant gains, closer to 10 or 100 times this amount, the conversion price is often negligible. Therefore, it's prudent to consider all convertible issues and warrants exercised when determining the actual number of common shares. If equity financing is likely within a few years of purchasing common stock and it results in minimal per-share earnings growth, one conclusion is clear. The company's management lacks financial acumen, making the common stock an unworthy investment. Unless this is the case, investors shouldn't be deterred by financial considerations from investing in a high-potential situation based on the remaining 14 points. Conversely, pursuing a situation with a poor score on these points just because of strong financials or cash position is not advisable for maximizing long-term profits. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 14. Does management share updates with investors openly when the company is thriving, but suddenly go silent when faced with challenges? In the world of business, even the most well-oiled machines can experience unexpected hurdles, such as sudden profit squeezes or shifts in product demand. The companies that offer the greatest potential for returns are often those at the cutting edge of innovation, constantly developing new products and processes. With innovation comes risk. Some ventures will falter. Others may face costly delays and unforeseen expenses that derail even the most optimistic forecasts. These setbacks are part and parcel of the journey to eventual success, and if handled with transparency and good judgment, can signal a company's resilience rather than its frailty. However, if a company that has previously shown promise starts to exhibit stagnant per-share earnings, it might suggest a lack of financial acumen in its management. This can make the stock a less attractive investment. But don't be dissuaded by financial hiccups alone. Look beyond to evaluate the company's overall potential using a broader set of criteria. How management deals with tough times can reveal a lot. If they are prone to clamming up when problems arise, it could indicate a lack of a solid recovery plan, rising panic, or a deficiency in accountability to shareholders. A company that hides or downplays bad news is a red flag. For savvy investors, it's wise to steer clear of companies that withhold critical information, especially when seeking long-term gains. Part 1. Common Stocks and Uncommon Profits. Chapter 3. What to buy. Point 15. Does the company have a management of impeccable integrity? In the intricate dance of corporate governance, the management holds a privileged position, often much closer to the company's assets than the stockholders. This proximity opens a multitude of avenues for self-enrichment, sometimes without crossing legal boundaries. One common strategy is to place themselves and their family members on the payroll at inflated salaries that far exceed the value of the work performed. Another tactic involves selling or renting properties to the company at above-market rates. While this may seem benign in smaller corporations, where families or key officers may genuinely aim to liberate working capital for the business, it can also mask more dubious motives. Insiders may also channel company funds through vendors or brokerage firms that offer little in return, but are owned by the insiders or their associates. However, the most costly misuse of power can occur in the realm of stock options. Here, insiders might award themselves shares far beyond what a dispassionate observer would deem a fair compensation for their contributions. The key to safeguarding against such abuses lies in investing only in companies with management teams that exhibit a profound sense of fiduciary duty and moral responsibility toward their shareholders. The scuttlebutt method, which involves gathering informal but insightful opinions about a company's management, can be instrumental in assessing this aspect. While a company might falter in other areas, a stellar reputation for integrity can still make it a worthwhile investment. Conversely, no matter how attractive other qualities might be, a serious deficiency in management's sense of stewardship should be a red flag for potential investors. Chapter 4. What to buy. Applying this to your own needs. When it comes to investing, the average individual often falls short of expertise. Whether a man or a woman, most investors allocate only a fraction of the mental energy and time to managing their investments compared to their primary work or daily responsibilities. This limited focus can lead to a muddled understanding of investing, shaped by half-truths and misconceptions. A particularly pervasive myth is the image of the investment wizard. Public perception often conjures a picture of a reclusive scholar, buried in balance sheets and financial statements, extracting hidden insights from mountains of data. This notion suggests that success in investing hinges solely on mathematical prowess and deep dives into statistics. In reality, this image is both misleading and dangerous. While certain aspects of investing do involve detailed calculations, the most successful investors often excel not just in number crunching, but in understanding and appraising business fundamentals. The pursuit of the best investment opportunities involves more than mere statistical analysis. It requires insight into the broader business context. For example, while statistics may reveal some bargains, these might come with hidden risks or long waits before their true value is realized. In contrast, investing in well-managed growth companies often yields superior long-term returns. These companies tend to grow significantly in value over the years, offering gains that far outstrip those of more conservatively valued stocks. If you're contemplating how much time you can dedicate to investing, you might find it a challenge. True investment success often involves networking and engaging with various people to gain valuable insights, which requires both time and interpersonal skills. Not everyone has the inclination or the ability to delve deeply into this aspect of investing. Geography can also play a role in investment success. An investor in Detroit might have better access to automotive industry insights, while someone in a rural area may face more challenges. However, even those in less central locations can still find promising opportunities, thanks to the widespread presence of major companies and industries. For many, managing investments is too complex a task to handle alone, just as one would not attempt to perform surgery or legal work without proper expertise. Investors should be equipped with enough knowledge to identify and select competent financial advisors rather than relying on trial and error. Selecting an advisor requires careful consideration. Look for a track record of solid performance over a meaningful period, typically 5 years or more. A true expert should demonstrate consistent results that reflect their skill, rather than just luck or market trends. It's also crucial to ensure the advisor's principles align with your own investment philosophy. Investors must choose between managing their investments themselves or hiring a professional. Large, established companies, often favored by institutional investors, offer stability and steady growth, like Dow Chemical or IBM. These stocks, though less flashy, provide reliable returns over time. On the other hand, smaller, younger companies with high growth potential can offer enormous gains, but come with higher risks. A balanced approach might involve investing the majority of funds in stable, established companies, while reserving a portion for high-risk, high-reward opportunities. For smaller investors, managing immediate income needs versus long-term growth is a crucial decision. Funds used for stock investments should be surplus, not earmarked for essential future expenses. Balancing between immediate returns and potential future gains depends on personal circumstances and investment goals. Ultimately, historical studies consistently show that growth stocks, while starting with lower yields, often outperform high dividend stocks in capital appreciation over time. These stocks not only appreciate significantly, but often increase their dividends as their value grows, making them a compelling choice for long-term investment. Chapter 5. The Art of Timing Your Purchase. In our quest for investment success, we've delved into the essence of identifying those rare stocks destined for remarkable growth. But does this make the timing of your purchase less significant? Once you've zeroed in on a stellar stock, shouldn't any time be a good time to buy? The answer hinges on both the investor's goals and temperament. Consider a dramatic historical example. Imagine having picked several stellar stocks in the summer of 1929, just before the monumental stock market crash. With the gift of hindsight, it's clear these stocks would have eventually soared. However, had you made an effort to understand the principles of timing, your gains could have been far more substantial. While choosing the right stocks and holding them long-term generally yields profits, timing your purchase can significantly amplify those returns. Traditional methods of timing stock purchases, using economic data to forecast market trends, often seem sensible but are fundamentally flawed. They involve analyzing a wealth of economic indicators to predict the near and medium-term state of the economy and interest rates. If forecasts are favorable, investors proceed with their buys. If signs of trouble emerge, they may delay or cancel purchases. The problem with this approach isn't that it lacks theoretical basis, but rather that it's practically unreliable. The current state of economic forecasting resembles the early days of alchemy, a field rich in speculation but lacking precise, actionable insights. Even with advances in technology, predicting business trends with accuracy remains elusive. Until breakthroughs occur, economic forecasting may remain as rudimentary as medieval chemistry. Consider the economic climate of 1929. Speculative fervor was at unprecedented heights, leading to easily identifiable bubbles. However, such clear opportunities are rare, perhaps occurring only once in a decade or less. Investors often place too much trust in economic forecasts, despite their track record of inconsistency. A review of historical financial literature reveals a staggering level of disagreement among experts. The stark contrasts between forecasts and their outcomes suggest that the mental energy devoted to economic predictions might be better spent on more fruitful endeavors. If traditional economic forecasting isn't the answer, where should investors turn for guidance on timing their purchases? The answer lies in understanding the inherent nature of growth stocks themselves. Outstanding investments typically operate on the cutting edge of technology, developing new products or processes that require substantial investment and time. During the initial stages of commercial production, these stocks often experience significant costs and delays. Investors must recognize that the most promising period for buying often comes during these challenging times. For instance, consider the challenges faced by a company launching its first full-scale commercial plant. Initial production setbacks and higher costs can cause stock prices to fall, even as the long-term potential remains robust. Investors who buy during these down periods, when the stock is undervalued, stand to benefit significantly when the company's operations stabilize and profits begin to climb. A case in point is American Cyanamid in 1954. Despite a troubled new plant and negative sentiment, certain investors saw an opportunity and bought shares at a low price. Over time, as the company's new plant became profitable and its earnings grew, the stock's value surged, delivering impressive returns. In summary, while selecting the right stocks is crucial, understanding the timing of your purchase can greatly enhance your returns. Buying during periods of temporary trouble, when prices are low, but the long-term outlook is strong, can set the stage for extraordinary gains. To conclude our discussion of American Cyanamid, let's end on a cheerful note. In the preface to this revised edition, I promised an honest record of events rather than a polished narrative. You may recall that in the original edition, I mentioned that certain funds bought Cyanamid stock in 1954. By spring 1959, these funds had sold their shares at an average price of $49, which, while below the current market value, still yielded a substantial profit of about 110%. The decision to sell was not influenced by this impressive profit. Instead, two key factors guided this choice. First, we anticipated a better long-term outlook for another company, which will be explored in the next chapter. Although the comparative market quotations for both stocks at that time supported this decision, the true test will come with the passage of time. The second, perhaps less justifiable reason, was concern over American Cyanamid's performance, especially in its chemical division. Despite the promising prospects of its pharmaceutical branch, the company's efforts to establish itself in the acrylic fiber market faced uncertainty and potential high costs. This decision might have overlooked future gains, particularly if the pharmaceutical division's bright prospects, including new antibiotics and an oral polio vaccine, come to fruition. Whether this move was a mistake or a prudent choice remains to be seen. I suggest that anyone keen on refining their investment strategies note these reflections and revisit them after reading the upcoming chapter on when to sell. Turning to a more recent example, let's revisit the Food Machinery and Chemical Corporation, which I mentioned in the original edition. In the latter half of 1957, this company was in a similar situation. Despite some institutional interest, many investors hesitated due to uncertainties surrounding the company's diverse operations. Before World War II, the company excelled in machinery manufacturing. During the war, it expanded into ordnance and chemicals to stabilize its cyclical machinery business. By 1952, the company had acquired and integrated several chemical companies, but their performance varied significantly. The financial community was skeptical until the company's management undertook a major overhaul, investing in modernization and research. Despite increased expenses, the company maintained steady earnings, suggesting that the groundwork for future improvements was being laid. Although earnings were expected to rise in the latter half of 1957, unforeseen issues delayed this growth until 1958. The company's performance in 1958, even amid economic downturns, was a sign of its chemical divisions reaching maturity. By 1959, profits were rising, despite transitions in the ordnance division. The stock price, which was 25.25 in September 1957, had surged to 51, reflecting a gain of 102%. This upward trend was further validated when the Food Machinery Corporation's chemical divisions won an industry award for management excellence, a recognition previously reserved for industry giants. This example highlights how a well-timed investment in a company undergoing significant improvements can yield substantial returns. It also underscores the importance of recognizing underlying growth prospects before they are reflected in stock prices. Whether facing corporate troubles or seizing new opportunities, investors should focus on companies with strong management and promising future prospects. In conclusion, whether you're seasoned in investing or just starting, it's essential to focus on companies poised for genuine growth and to remain patient and strategic in your investment approach. Ignoring short-term market fluctuations and concentrating on fundamental improvements will often lead to more rewarding outcomes in the long run. Chapter 6: The Art of Timing. When to sell and when to hold. In the intricate dance of investing, knowing when to sell a common stock is just as crucial as knowing when to buy. While personal reasons like financing a new home or supporting a child's business venture can make selling seem sensible, these are outside the realm of financial strategy and won't be our focus here. Instead, we'll zero in on selling driven by a singular objective: maximizing your investment's dollar benefit. Let's break down the scenarios when selling a stock, once chosen with care, becomes necessary. 1. Recognizing a mistake. The first and perhaps most clear-cut reason to sell is when you realize a mistake was made in your initial purchase. If new information reveals that a company's prospects are far worse than initially thought, it's time to act. Handling this situation demands emotional discipline and honesty. Admitting a mistake is tough. Our egos prefer to believe we were right. However, holding on to a stock that's no longer a good fit because we're reluctant to accept a small loss can be costly. It's not just about the immediate loss, but the potential gains missed by not reallocating the funds to a better opportunity. 2. Deterioration in company performance. The second reason for selling is if the company no longer meets the high standards it once did. This could stem from management issues or market saturation. Sometimes the decline is due to a loss of effective leadership or a market that has outgrown the company's initial growth potential. When a company's stock no longer meets the rigorous criteria established at purchase, it's time to consider selling, even if it means facing a capital gains tax. For instance, if the company's growth prospects are now aligned with the broader industry average rather than its previous stellar performance, or if new leadership hasn't maintained the high standards of their predecessors, selling might be prudent. While you might hold on to some shares for a while, recognizing when a stock has reached its zenith and needs to be replaced is essential. Number 3. Reallocating to better opportunities. The third reason for selling involves the hunt for better investment opportunities. If your current investment, while still good, is outperformed by another opportunity with superior prospects, it may be worth switching. This requires careful consideration and confidence in the new investment's potential. The capital gains tax is a real concern, but if the new opportunity promises significantly higher returns, the switch could be worthwhile. Nonetheless, caution is advised. The allure of a seemingly better option should be weighed against the risk of misjudging the new opportunity. Often, investors who have held a stock for a while know its strengths and weaknesses intimately, making them more informed and less susceptible to making hasty decisions. Despite these reasons, there's a core principle that savvy investors grasp. If a stock has passed the test of time and remains fundamentally strong, it should be sold only under rare and compelling circumstances. Many advisors suggest selling stocks based on short-term market fluctuations or fears of an impending downturn, but these strategies can be flawed. Selling a well-performing stock due to concerns about a market correction or because it appears overvalued can lead to costly mistakes. Instead, maintain focus on the stock's long-term potential. The notion that a stock is overpriced often fails to account for its future growth. Even if a stock seems expensive in the short term, if its long-term prospects remain strong, it's often wiser to hold. In summary, the essence of successful investing is understanding that once a stock is chosen wisely and performs well, the decision to sell should be driven by clear, objective reasons rather than market whims or temporary price movements. As a guiding principle, If the job was done right when buying a stock, the time to sell it is almost never. Chapter 7. The Hullabaloo About Dividends. When it comes to common stock investments, few topics stir up as much muddled thinking and misguided beliefs as dividends. Investors often grapple with confusion and half-truths, especially when faced with the complex world of dividend actions. Consider the following scenario. A company has been either withholding dividends or paying a meager amount. The president, aiming to appease stockholders, persuades the board to declare a substantial dividend. The board and the president might proclaim this decision as a step to do something for the stockholders, implying that a lack of dividends equates to neglect. While this might hold some truth, it overlooks a crucial point. The company could be investing earnings into projects like a new plant, a product line, or cost-saving technologies, potentially benefiting stockholders far more than merely distributing dividends. The term favorable is often used to describe an increase in dividend rates, while a decrease or elimination is deemed unfavorable. This labeling stems from a widespread confusion about how retained earnings benefit stockholders. Sometimes, retained earnings offer no tangible benefit. For instance, if a company accumulates cash reserves beyond its needs, it might just be bolstering its own sense of security at the stockholder's expense. However, modern tax laws have mitigated this issue to some extent. Another scenario arises when subpar management retains earnings not to enhance efficiency, but merely to expand an already ineffective operation. Here, management might justify higher salaries by expanding their domain, resulting in little to no benefit for stockholders. Investors following a rigorous evaluation process, buying stocks based on quality rather than just low price, are less likely to encounter these issues. Such investors seek companies with strong management that effectively utilizes surplus cash. Now, let's delve into why retained earnings might not increase stockholder value. One reason is that companies sometimes spend on assets that don't boost business value, but are necessary to remain competitive, like installing costly air conditioning systems. In this case, even though expenditures are made, stockholders might not see a corresponding increase in their holdings' value. Another reason lies in the flawed nature of accounting in a world of fluctuating money values. Depreciation schedules based on fixed values often fall short of covering the replacement costs of outdated assets. This discrepancy means that retained earnings might simply be covering depreciation shortfalls rather than enhancing business value. Growth companies, which rapidly acquire new assets, are generally less affected by this issue. For these firms, retained earnings often fund new investments rather than merely replacing old assets. Examining the benefits of retained earnings for different types of investors highlights that dividend policies should be considered in light of individual investment strategies. For instance, some believe that raising dividends benefits smaller stockholders who face higher relative taxation on their income. However, if investors are reinvesting their earnings, they might actually benefit more from the company retaining earnings to capitalize on growth opportunities. A good dividend policy should provide predictability and consistency. Investors value reliability in dividends to plan their financial futures, rather than abrupt changes or one-off extra payouts. Companies that adopt and adhere to a stable dividend policy, whether retaining earnings for growth or paying out a steady dividend, tend to build a loyal investor base. The wisdom of choosing stocks based on a consistent dividend policy over high yields is evident in historical performance. For example, Rohm and Haas, which began with a low dividend yield, saw its stock value increase significantly due to the company's successful growth strategy. This illustrates that high yields are not always the best indicator of long-term value. In essence, dividends should not be the sole focus for investors seeking outstanding stocks. Often, those who overlook dividend yield in favor of strong management and growth potential find themselves with superior returns. Thus, the most fruitful investments frequently come from companies with relatively low dividend yields but exceptional growth prospects, proving that thoughtful investment strategy outweighs the allure of high dividend payouts. Chapter 8. 5 Don'ts for Investors. 1. Don't buy into promotional companies. At the core of successful investing lies the quest for companies that are innovating, exploring new markets, or pioneering groundbreaking technologies. Freshly minted companies often fit this bill, whether they're launching a dazzling new invention, diving into booming industries like electronics, or hunting for hidden mineral riches. At first glance, these startups, with their promise of potential, might seem like golden investment opportunities. The allure intensifies when you hear the pitch. By snagging shares during the initial offering, you could be getting in on the ground floor. The notion is tempting. Imagine the returns if the company's value skyrockets, like those that have multiplied many times since their early days. So why not use the same rigorous analysis to spot these burgeoning stars as you would for established giants? However, from an investment perspective, there's a critical distinction to be made. Companies without a track record of at least 2 to 3 years of operation and 1 year of profitability are fundamentally different from seasoned players, even if they're relatively small. Established companies have well-oiled machinery. Their production, sales, cost accounting, and management practices are in full swing. Investors can observe these operations in action and tap into insights from other industry experts who provide a clearer picture of the company's strengths and weaknesses. In contrast, promotional companies are a different beast altogether. Investing in them is akin to looking at an intricate blueprint and trying to predict how it will function once built. The risks are significantly higher due to the unpredictability of nascent operations. Even the most astute investor can't match the accuracy of selecting successful companies when restricted to the untested waters of new ventures. Often, these startups are helmed by 1 or 2 visionary individuals with exceptional skills in specific areas, be it sales or production, but who may lack critical business acumen in other areas. They might excel at creating innovative products, but falter in marketing or management. Investors usually cannot provide the necessary expertise or influence to address these gaps effectively. Given these challenges, it's wise to let specialized investment groups handle the financing of promotional companies. These groups have the necessary management talent and experience to navigate and mitigate the weaknesses that arise. For individual investors, the potential pitfalls of promotional companies far outweigh the benefits. Instead, focus on the wealth of opportunities available among established companies, where the risk is more manageable and the odds of success are higher. 2. Don't overlook a promising stock just because it's traded over the counter. It's easy to dismiss over-the-counter, OTC, stocks simply because they're not listed on major stock exchanges. However, this could mean missing out on significant investment opportunities. OTC stocks, often misunderstood, can offer excellent marketability despite not being listed. Historically, stock trading has evolved dramatically, especially from the speculative frenzy of the 1920s to the more regulated and cautious market of the 1950s and beyond. This evolution has led to a diverse range of investors, from small individual buyers to large institutional investors like pension funds and investment trusts. One key change is the shift from brokers who merely execute trades to stock salesmen who actively persuade and guide investors. This has led to higher commissions, but also more tailored investment advice. Over-the-counter markets operate differently from stock exchanges. Instead of central clearinghouses, OTC dealers provide bid-and-ask quotations, offering flexibility and often better liquidity for certain stocks. Investors may find that OTC stocks, handled by reputable dealers, can be just as marketable as those listed on smaller exchanges. Some companies even prefer OTC trading until they grow large enough for major exchange listings. Ultimately, the same principles apply. Choose the right security and work with a reliable broker. With these in place, the distinction between OTC and exchange-listed stocks becomes less critical. So don't dismiss a good stock just because it's traded over the counter. It might be a hidden gem. 3. Don't let the sweet talk fool you. Investing beyond the glossy annual report. It's easy to get swept away by the polished prose and slick visuals of a company's annual report. Many investors unknowingly base their stock choices on the compelling narrative rather than the hard numbers. The tone of an annual report might echo the company's philosophies, policies, or aspirations, but it can just as easily be the handiwork of a talented public relations team spinning a compelling tale. The CEO's thoughtful letter? It might be penned by a PR officer rather than the executive themselves. Stunning photos and vibrant charts? They don't necessarily depict a cohesive, high-performing management team brimming with enthusiasm. Relying on the charming words of an annual report to guide your stock purchases is akin to choosing a product based on a flashy billboard ad. Sometimes the product lives up to the hype, other times it falls short. While such impulsive buying might be excusable for low-cost items, when it comes to stocks, few of us can afford to make decisions on a whim. Modern annual reports are crafted to foster stockholder goodwill, often showcasing the company in the best possible light. They rarely provide a balanced view, glossing over the real challenges and potential pitfalls the business faces. So should you let an engaging annual report push you to buy a stock? Absolutely not. But what about the flip side? Should a lackluster report deter you? Again, usually not. Judging a company solely by the tone of its report is like evaluating a gift based on its wrapping paper. There's an exception, though. If an annual report omits crucial information, that's a red flag. Companies that skimp on transparency are typically not the best investment bets. In summary, look beyond the enticing narrative. Dig into the financials, understand the core business, and base your investment decisions on solid facts rather than alluring fiction. Four, don't be fooled by the high price of a stock compared to its earnings. It doesn't necessarily mean that future growth is already baked into the price. Let's illustrate this with an example. Imagine XYZ Corporation, a fictitious company that has consistently excelled for decades. XYZ has a stellar track record with constant growth in sales and profits and a promising pipeline of new products. The financial community recognizes its excellence, so XYZ's stock has been selling at a price-earnings PE ratio of 20 to 30 times its current earnings, double the PE ratio of the average Dow Jones stock. Currently, XYZ is selling at twice the PE ratio of the Dow Jones average, suggesting it's priced much higher in relation to its earnings. The company just announced it expects to double its earnings in the next 5 years, and the forecast seems credible. However, many investors mistakenly conclude that because XYZ's stock is already high, its price reflects future earnings and is therefore overpriced. But here's where their logic falters. They assume that 5 years from now, XYZ will have the same PE ratio as the average Dow Jones stock. For the past 30 years, XYZ has consistently sold at twice the PE ratio of other stocks due to its superior performance. If XYZ continues its successful strategies and introduces new products that drive earnings growth, there's no reason why it shouldn't continue to sell at a higher PE ratio. Assuming the PE ratios remain stable, doubling earnings would also double XYZ's stock price over the next 5 years. This means the current price isn't necessarily discounting future earnings. Many investors, especially when dealing with newer companies like ABC Corporation, a younger version of XYZ with similar potential, struggle with this concept. They fail to recognize that a high PE ratio might reflect the company's quality rather than an overestimation of future growth. Understanding the nature of a company and its long-term prospects is crucial. If a company's growth is a one-time event, a high PE ratio might indeed discount future earnings. However, if a company consistently develops new growth opportunities and operates in a promising industry, its future PE ratio is likely to remain high. In such cases, what appears to be an overpriced stock might actually be a hidden gem, offering substantial value and growth potential. Five, don't quibble over eighths and quarters. I've often used hypothetical examples to clarify investment principles, but this time, let's dive into a real-world story. Over 2 decades ago, a shrewd investor wanted to purchase 100 shares of a stock listed on the New York Stock Exchange. On the day he decided to buy, the stock closed at 35.5. The next day, it traded repeatedly at that same price. However, this gentleman refused to pay 35.5, He aimed to save $50 and placed his order at $35. He wouldn't budge. The stock never dropped to his target price. Today, nearly 25 years later, the stock, buoyed by dividends and splits, is worth over $500. In his bid to save $50, this investor missed out on making at least $46,500. He still holds other shares of the same company, purchased at even lower prices, which makes it clear that he would have indeed made this profit. To put it in perspective, he would need to save $50 930 times to compensate for this missed opportunity. This kind of decision-making is nothing short of financial madness. This example is not an outlier. I intentionally chose a stock that was more of a market underperformer than a leader for several years. Had our investor chosen any of the top 50 growth stocks on the New York Stock Exchange, the loss from saving $50 could have been much greater than $46,500. For small investors wanting to buy a few hundred shares, the rule is straightforward. If the stock seems right and the price is reasonable, buy at the market. The small difference in price, be it an eighth, a quarter, or even a half point, is negligible compared to the potential profit missed if the stock isn't acquired. If the stock doesn't have significant long-term potential, the investor probably shouldn't be buying it at all. For larger investors seeking thousands of shares, the problem is more complex. Most stocks have limited supply, so buying a large block at the market price could cause a significant price increase. This spike might attract other buyers and prompt current holders to delay selling, hoping for further price rises. What should a large buyer do? The investor should work closely with a broker or securities dealer, disclosing the exact amount of stock desired and authorizing the broker to buy as much as possible without triggering competitive bids. Crucially, the investor must give the broker discretion on price, allowing purchases somewhat above the most recent sale price. The exact premium should be decided based on factors like the size of the block, typical trading volume, the investor's eagerness, and any special considerations. If the investor lacks a broker or dealer with the necessary judgment, it's imperative to find one. After all, guiding such transactions is a broker's primary function. Chapter 9. 5 more don'ts for investors. 1. Don't overstress diversification. No investment principle is more widely acclaimed than diversification. Some cynics even joke that this is because it's so simple that even stockbrokers can grasp it. Regardless, the average investor is well aware of the dangers of putting all their eggs in one basket. The horrors of insufficient diversification are constantly emphasized. However, too few people consider the pitfalls of the other extreme. Having eggs in so many baskets can lead to mediocre returns, as it's impossible to keep a vigilant eye on all of them. For instance, among investors with substantial portfolios, it's alarming how many hold 25 or more different stocks. The problem isn't the number itself, but that only a small percentage of these stocks are ones they know well or believe in strongly. The fear of concentrating too much in one area leads many to spread their investments too thinly, often into companies they know nothing about. This can be riskier than having too little diversification. So how much diversification is really necessary? It's similar to infantrymen stacking rifles. A stable stack requires more than 2 but doesn't need 50. The type of stocks matters a lot, though. Some companies, like major chemical manufacturers, have internal diversification due to their varied products and markets, reducing the need for external diversification. Others, particularly those in highly cyclical industries, might require more diversification to balance risks. There's no one-size-fits-all rule, but here's a rough guide. A. For those investing in large established growth stocks like Dow or IBM, 5 different stocks might be sufficient. This means not more than 20% of the total investment in any one stock. As long as they're in different industries or have minimal overlap, this should provide adequate diversification. B. Mid-sized companies, those between young growth firms and large institutions, might require a different approach. Investing 10% in each of 10 such companies could offer the right balance. However, companies with higher risks should perhaps get only 8% of the original investment. C. For small companies with high potential but high risk, Never invest more than you can afford to lose. Larger investors should limit any single investment to 5% of their funds. The essence is not to avoid diversification, but to avoid overstressing it. Holding too many stocks can indicate uncertainty and lead to poorer performance. A well-considered portfolio of a few outstanding stocks is far better than a scattered collection of mediocre ones. Remember, in investing, a little bit of many can never substitute for a concentrated stake in the best. Two, embrace the opportunity during a war scare. When the drums of war start beating, the reaction in the stock market is often dramatic and visceral. Common stocks, which are often favored by those with a vivid imagination, reflect the raw panic and dread of wartime fears. The sight of conflict and chaos distorts our financial perceptions, leading to a market that reacts more to fear than to reason. The horrors of war are gut-wrenching, and in today's nuclear age, the anxiety extends beyond the battlefield to our personal safety and that of our loved ones. This pervasive fear leads us to overlook fundamental economic factors and to overestimate the negative impact of war on financial markets. History shows that, with a single notable exception, each major war or conflict has caused the American stock market to plunge as fear takes hold. World War II, starting in September 1939, saw an initial dip, but even then, stocks eventually soared as the dust settled. Despite the immediate fallout, stocks generally rise after the end of hostilities. This happens because war usually leads to increased government spending and, consequently, inflation. In wartime, governments print more money, which dilutes its value and pushes up stock prices. Selling stocks during a war scare or when conflict erupts is often a misguided move. Instead, buying stocks during these times can be advantageous. When war looms, the prudent investor should seize the moment to buy, albeit cautiously. Start buying gradually during a war scare and increase your purchases if war actually breaks out. Focus on companies with products or services that remain in demand during wartime, or those adaptable to wartime production. While the specific real value of stocks may vary depending on the outcome of the conflict, the general trend is clear. Money loses value, and stock prices tend to rise as a result. Thus, the real opportunity lies not in fearing war, but in understanding that historically, war tends to devalue money while pushing stock prices higher. It's not the war itself that makes stocks valuable, but the inflationary effects it has on money. Three, don't forget your Gilbert and Sullivan. While Gilbert and Sullivan might not be the first names that come to mind in discussions of stock market wisdom, their light-hearted line about flowers that bloom in the spring trala that have nothing to do with the case holds a surprisingly astute lesson for investors. Often, financial statistics receive undue attention, much like these flowers, seemingly charming but largely irrelevant to the matter at hand. Take, for instance, the obsession with historical price ranges. When evaluating a stock, many investors first seek out the highest and lowest prices it has reached over the past several years. They then perform mental gymnastics to arrive at a price they're willing to pay, based on these past figures. This approach is not only illogical, but financially hazardous. By fixating on what's behind rather than what lies ahead, investors risk overlooking opportunities for significant gains in favor of safer, less promising options. Why is this approach flawed? Stock prices reflect the current market consensus on a company's value, shaped by the latest news and trends. The price from 4 years ago is a relic of a different era, one that might have seen a company underperforming or thriving for reasons unrelated to its present potential. A stock's past price could be irrelevant if the company has since grown new leadership, launched innovative products, or faced operational decline. The crux is that the market value of a stock today is based on the current appraisal of the company's prospects, not a distant snapshot. Similarly, per-share earnings from years gone by are often given undue weight. Reviewing these numbers without considering the current context is akin to using a disconnected engine to assess its performance. It's crucial to understand the present and future prospects of the company rather than dwelling on outdated statistics. Investors frequently encounter reports filled with historical data because such figures are easy to verify and less prone to misinterpretation. However, this can obscure the more significant, though less immediately measurable, factors that will drive future performance. For instance, in 1956, Texas Instruments was undervalued despite its promising trajectory. Those who focused solely on past earnings and price trends missed a lucrative opportunity, as the company's growth and innovations led to a dramatic increase in its stock value over the following years. In essence, historical statistics can serve as useful tools for understanding trends and evaluating cyclical behavior, but should not overshadow the critical factor, future potential. The lesson is clear. While past figures have their place, they have nothing to do with the case when it comes to making forward-looking investment decisions. Prioritize the future over the past to make the most informed and profitable choices. When considering an investment in a true growth stock, it's essential to weigh not just the price, but also the timing of your purchase. Let's explore a scenario that illustrates this point. Imagine a company that perfectly fits our 15-point investment criteria and is poised for a significant increase in earnings a year from now. This potential growth is currently under the radar of most investors, but it promises to continue expanding for several years beyond that. At first glance, this stock seems like an obvious buy. However, a complication arises. The company's past successes have given it considerable hype, leading to an inflated stock price. What was once a reasonable price of 20 is now elevated to 32, largely due to this hype. Here's the dilemma. The stock might be worth around 75 in 5 years, thanks to the upcoming growth. Should you invest now at 32, knowing that it could drop to 20, or wait for a potential price correction? If the stock does fall to 20, you'd have more shares for your money, increasing your potential gains when the stock reaches its projected 75. Conversely, if the stock remains high or increases further, waiting might cost you valuable time. Many conservative investors would monitor the stock closely and buy only if it approaches the 20 mark. However, this approach overlooks a crucial factor: the timing of new developments. Past ventures by this company showed that their impact on stock price typically becomes apparent about a month before they hit the pilot plant stage. If the stock is still around 32, a strategy could be to plan your purchase for 5 months from now, just before this critical stage. This tactic isn't about ignoring value, but rather optimizing the timing of your investment. By aligning your purchase with key milestones, you increase the chance of acquiring the stock at or near its lowest price before significant growth occurs. This approach balances the risks of potential price drops with the opportunity to secure a stock poised for substantial future gains. Ultimately, this strategy highlights that buying at a particular date, when informed by the company's development timeline, can be just as effective, if not more so, than focusing solely on the price. This way, you align your investment with the company's growth trajectory, potentially maximizing your returns. Top 5. Dare to be different. The art of not following the crowd. Navigating the financial world can be a bit like trying to read the wind. It's not always clear, and often you can't pin it down with a simple formula. This is especially true when it comes to understanding how and why stock prices change. Throughout this book, we've explored how various factors like changes in net income, management shifts, new inventions, or shifts in tax laws can impact a stock's price. But beyond these tangible changes lies a more elusive force: the power of psychology. Just as fashion trends sway our choices in clothing, the financial community's mood swings can drastically distort stock values. Take, for instance, the post-World War II stock market scene. In 1948, despite Dow Chemical's soaring earnings, many seasoned investors dismissed its stock, convinced it was riding a temporary post-war wave destined to crash. Their view was heavily influenced by a widespread belief that a new depression was imminent, mirroring patterns from previous wars. The result? A temporary undervaluation of Dow's stock, despite its solid fundamentals and promising innovations. In reality, the anticipated depression didn't materialize, and as confidence returned, stock prices surged. This psychological shift illustrates how the collective mindset of the financial community can drastically alter the perceived value of stocks, regardless of the underlying facts. This phenomenon isn't confined to stocks alone. Entire industries can swing in and out of favor based on prevailing sentiments. Consider the defense industry, sometimes viewed as risky due to its dependency on government contracts and the potential for peace to disrupt business. At other times, it's seen as a stable, long-term investment due to ongoing military needs and technological advancements. Similarly, pharmaceutical stocks have oscillated in attractiveness based on industry-wide developments and individual company performances. To profit in such an environment, investors must develop a keen sense of when to swim against the tide. When the financial crowd is exuberant, the prudent investor should scrutinize whether the hype is justified or if they are overpaying for an overhyped trend. Conversely, when the market is overly pessimistic, it may present opportunities to buy undervalued stocks poised for a rebound. An investor's edge often comes from recognizing when the crowd's opinion has swung too far in one direction. For example, if a company's stock is undervalued due to poor management, but a new, yet unheralded leader takes the helm, the stock may still lag behind even as its potential improves. Identifying these situations before the market catches on can lead to significant rewards. Ultimately, success in investing often comes down to the courage to think independently. By evaluating facts critically and resisting the urge to follow the herd, you can uncover opportunities that others might miss. Remember, the most rewarding investments are often those that challenge the conventional wisdom of the crowd. Chapter 10: The Art and Science of Unearthing Growth Stocks. After the initial buzz surrounding common stocks and uncommon profits, my mailbox overflowed with letters from eager readers nationwide. They all wanted one thing: more insight into the elusive art of finding stocks that could skyrocket in value. Given the volume of interest, I thought it fitting to dive deeper into this subject. Finding a growth stock is no small feat. It demands not just time and skill, but a sharp, discerning eye. For the small investor, the effort might seem disproportionate to the capital at hand. Yet whether you're investing a modest sum or a substantial fortune, the quest for that next big winner remains equally demanding. If there were an easy formula for spotting a bonanza stock, I'd be the first to share it. Sadly, no such shortcut exists. The amount of time you invest in this search should be proportional to your financial commitment and personal capacity. While I can't claim my approach is the sole or even the best method, it's the one that has served me well over the years. I've refined my process to the point where it consistently delivers favorable results. This process can be broken down into two critical stages, each with its own pivotal decision. The first stage involves an initial screening to identify potential candidates from thousands of stocks. The second, far more decisive, involves determining whether to invest in a stock that has made it through the initial culling. The crux of the challenge lies in selecting which stocks warrant a deeper dive. With countless possibilities, you must sift through potential candidates with minimal information, a task fraught with risks. You could end up overlooking a gold mine or investing in a dud. Hence, the critical early decisions are crucial, setting the stage for whether you're prospecting for valuable ore or just a bit of gravel. Years ago, I thought I had the perfect system. I tapped into my network of business executives and scientists for tips, believing these insiders could point me toward high-potential stocks. However, upon reflection, I found that this approach yielded less than expected. Surprisingly, only a small fraction of the leads from these well-connected sources turned into worthwhile investments. In contrast, most of my successful investment leads came from a different source: a select group of talented investment professionals scattered across major cities. These individuals, despite their varying opinions, consistently provided leads that proved fruitful. Their insights into the industry and individual companies often led to discoveries of high-growth potential stocks. On the other hand, printed materials and general brokerage reports proved less reliable. They often regurgitate common knowledge or suffer from inaccuracies, making them poor sources for groundbreaking investment ideas. Major consulting research firms, while possessing potentially valuable information, typically withhold details due to client confidentiality, further complicating the search. So, how does one proceed after gathering initial leads? Here's where the scuttlebutt method becomes indispensable. Instead of diving straight into detailed company reports or management meetings, I first gather informal feedback from a network of contacts. I reach out to customers, suppliers, competitors, and anyone with insider knowledge. If this groundwork yields promising results, I then delve into a more formal analysis, including scrutinizing financial statements and product details. If, despite all efforts, I can't secure enough information to make an informed decision, I abandon the investigation. The goal is not to pursue every possible lead, but to focus on the few with the highest potential. When valuable information is available, I then proceed to engage with company management. This step is crucial, as it allows me to verify the insights gathered through scuttlebutt and assess the management's competence. In summary, finding a growth stock is an arduous but rewarding process. It involves extensive research, strategic use of personal and professional networks, and careful evaluation of company fundamentals. The goal is not merely to find any stock, but to identify those with the potential for substantial growth, and this requires both rigorous effort and keen judgment. So why go through all this effort? Because the potential rewards are unparalleled. Investing in growth stocks successfully can yield returns that dwarf initial investments, but this level of success isn't achieved by shortcuts or superficial analysis. It demands a blend of hard work, insightful judgment, and a methodical approach. By following these principles, one can uncover those rare, lucrative opportunities that can transform a modest investment into substantial wealth. Chapter 11. Summary and conclusion. As we embark on the second decade of a 50-year span that promises unparalleled advancements in the human standard of living, we find ourselves standing on the brink of a financial era that could outshine the progress of the past 5 millennia. The investment landscape of the recent past has been marked by both substantial risks and impressive rewards, but what lies ahead may dwarf these experiences in both scope and significance. In this context, it's crucial to assess our current position. While we have not entirely vanquished the business cycle, we have introduced new dynamics that have transformed the art of investing in common stocks. Notable among these is the rise of modern corporate management, which has substantially bolstered the investment appeal of common shares. Additionally, the integration of scientific research and developmental engineering into the economic framework has further reshaped the investment landscape. Despite these advancements, the fundamental principles of successful common stock investment remain unchanged, and in fact have become more vital than ever. This book has sought to illuminate these core principles: the types of stocks to target, the optimal timing for their acquisition, and most importantly, the value of holding on to these investments as long as the underlying company continues to exhibit exceptional qualities. The sections on common investment mistakes are intended to provide insight and guidance. However, mastering these principles alone will not suffice without a foundation of patience and self-discipline. As one of the most astute investors I've encountered once shared, a calm and resilient mindset can be even more critical than intellectual acumen in the stock market. Perhaps Shakespeare captured the essence of successful investing best when he wrote, "There is a tide in the affairs of men which, taken at the flood, leads on to fortune." Part 2. Conservative investors sleep well. Throughout my career, I've held firm to a mantra that I believe drives the success of any business: the principles of integrity, ingenuity, and hard work. These 3 pillars, 2 I's and an H, have been my compass and my safeguard. In this chapter, I dedicate these reflections to my 3 sons, each embodying these values in their own unique ways. Arthur and Ken are navigating businesses closely aligned with my own, guided by the same principles that have been my foundation. Don, meanwhile, applies these principles in a different realm altogether. Together, they uphold the legacy of these core values, ensuring that conservative investors can rest easy, knowing that diligence and ethical practice are in capable hands. Introduction. Navigating the tides of American investment can often feel like sailing through a stormy sea with no visible shore. Right now, the mood among investors is darker than it has been at any point in this century, with morale plummeting to depths not seen since the turbulence of the 1970s. The Dow Jones Industrial Average, a frequently cited barometer of stock market trends, reflects daily fluctuations but may obscure the true scale of distress faced by those who have held common stocks in recent years. One particular index, which tracks all publicly traded common stocks without weighting by share volume, reveals a sobering reality. By mid-1974, the average stock had lost a staggering 70% of its value from its 1968 highs. In the face of such profound losses, investor behavior has followed predictable patterns. Many have retreated from stocks altogether, seeking refuge in seemingly safer assets. Yet, amidst the rising tide of inflation, some corporations are thriving, suggesting that well-chosen stocks might be less risky than traditionally safe alternatives. A notable group of investors, driven by a desire to act more conservatively, has restricted their investments to large, well-known companies. Names like Penn Central and Consolidated Edison, once deemed safe bets, have become cautionary tales, revealing the thin line between conservative and conventional investing. To truly understand conservative investing, it's essential to distinguish between two key concepts. 1. A conservative investment, one that is likely to preserve purchasing power with minimal risk. 2. Conservative investing, the process of understanding what constitutes a conservative investment and rigorously evaluating specific investments to ensure they meet these criteria. Being a conservative investor requires more than just following conventional wisdom. It demands a clear grasp of what makes an investment genuinely conservative, and a diligent approach to verifying that individual choices align with these principles. The importance of clarifying these concepts cannot be overstated. The recent investor bloodbath, rivaling only the Great Depression in severity, underscores the need for a renewed understanding of investment fundamentals. With America's potential for progress and innovation, re-education is crucial for both investors and the investment industry. Only then can the market for new stock issues be revitalized, enabling companies to secure necessary funds without the inefficient and costly reliance on government financing. In addressing today's investment challenges, this book draws heavily on the insights of my son, Ken, whose contributions shaped its title and core ideas. My gratitude for his support is immense. The book is structured into 4 distinct sections. 1. The anatomy of conservative investment, delving into what makes an investment genuinely conservative. 2. Financial community analysis, examining the mistakes that fueled the current bear market and how similar errors can be avoided. 3. Procedural approach to conservative investing, outlining the steps needed to identify and pursue conservative investments. 4. Current market influences, evaluating whether common stocks remain a viable asset for preserving wealth or if they have become mere gambling instruments. Through this exploration, I hope to illuminate whether the challenges of the recent bear market represent a pitfall or a profound opportunity for those who can think independently and resist prevailing market emotions. Philip A. Fisher, San Mateo, California. Chapter 1. The first dimension of a conservative investment: mastery in production, marketing, research, and financial skills. Navigating the world of conservative investments often feels like deciphering an intricate puzzle. The heart of a solid investment lies in understanding the fundamental dimensions that make a corporation not just competent, but exceptional. To grasp this, let's delve into one pivotal dimension that defines a robust investment. This dimension can be dissected into 4 essential pillars. 1. Low-cost production, a pillar of conservative investment. To truly embrace a conservative investment approach, a company must excel as a low-cost producer, ideally leading the pack in most, if not all, of its product lines. This status is not just a mark of current efficiency, but a pledge of future cost effectiveness. Such a position allows for a robust margin between production costs and selling prices, creating two crucial advantages. First, a low-cost producer enjoys a substantial buffer below the competition's break-even point. When the industry faces a downturn, prices may dip below this threshold, but for a low-cost company, such dips represent an opportunity rather than a threat. Competitors with higher costs might buckle under the pressure, leading to their exit from the market. As these competitors close shop, the surviving low-cost firms capture their lost demand, benefiting from increased market share and the potential to raise prices as supply tightens. Second, a strong profit margin provides the means for a company to internally fund its growth. This self-sufficiency minimizes the need for external capital, avoiding the pitfalls of issuing new shares, which dilutes existing ownership, or incurring debt, which burdens future earnings with fixed payments. However, it's essential to recognize that while being a low-cost producer enhances investment safety, it can diminish speculative allure during booming markets. High-cost competitors often experience more dramatic profit spikes in good times. For instance, imagine two companies both selling widgets at 10 cents each. Company A, with a profit of 4 cents per widget, and Company B, with a profit of 1 cent. If the price rises to 12 cents, Company A's profits increase by 50%, while Company B's profits triple. Consequently, in a bullish market, high-cost companies may appear more lucrative. Yet, when prices revert to 8 cents, the low-cost Company A remains profitable, while Company B may struggle, leaving its investors with potential losses. These principles are primarily relevant to manufacturing, where production is key. However, they extend to service-oriented sectors like wholesaling, retailing, or finance. In these cases, operations replaces production, and the same cost-efficiency principles apply to operators as they do to producers. Two, building a robust marketing organization. In the ever-evolving world of business, a strong marketing organization isn't just a luxury, it's a necessity. Imagine a top-tier manufacturer of horse-drawn buggies at the dawn of the automobile era, stubbornly perfecting their buggies while ignoring the rise of cars. That company would have faced an inevitable downfall, much like the automobile industry segments that failed to embrace the shift towards smaller, fuel-efficient cars before the Arab oil embargo highlighted the drawbacks of gas-guzzling giants. But recognizing a shift in consumer preferences is only the beginning. In the fiercely competitive market, it's not enough to simply have a superior product. You must also ensure that potential customers are aware of its advantages. This requires a deep understanding of what buyers truly desire, even if they themselves are unsure why certain features appeal to them, and communicating these benefits in terms that resonate with their needs and values. Whether through advertising, direct sales, independent marketing firms, or a mix of these methods, every strategy demands meticulous oversight and regular assessment of its cost-effectiveness. Without exceptional management in these areas, a business risks losing valuable customers, incurring higher costs with diminished profits, and failing to maximize the profitability of its product line. Picture an efficient engine hindered by a loose belt or misaligned gears. It's powerful but underperforming. Similarly, a company with a weak marketing strategy, despite its strong production capabilities, will only achieve a fraction of its potential. Number 3. Outstanding research and technical effort. Not too long ago, the realm of exceptional technical prowess seemed reserved for a handful of industries: electronics, aerospace, pharmaceuticals, and chemicals. However, as these fields have evolved, their technological innovations have seeped into nearly every sector, from manufacturing to service industries. Today, having top-notch research and technical talent is almost as crucial for a shoe manufacturer, a bank, a retailer, or an insurance company as it is for those once considered the epitome of scientific sophistication. Technological endeavors now diverge into two primary paths: creating new and improved products, and enhancing services to be more efficient or cost-effective. While research scientists in a chemical company might push boundaries differently compared to those in a grocery chain, both areas benefit immensely from exceptional technical talent. In fact, many service industries are pioneering new product lines while refining existing services. Take banks, for instance. Innovations like low-cost electronic devices and mini-computers have enabled them to offer advanced accounting and bookkeeping services, thus opening new avenues for growth. The variance in research and technology efficiency between companies mirrors the disparities seen in marketing. Developing new products is inherently complex, and success often hinges on more than just the technical skills of individual researchers. The ability of a research team to collaborate effectively, stimulate innovation, and integrate their efforts is crucial. Furthermore, successful product development demands not only technical excellence, but also alignment with market needs, compatibility with existing marketing strategies, and production feasibility. A research team, no matter how skilled, becomes ineffective if their innovations fail to reach the market or are priced out of profitability. For true investment excellence, a company must master the intricate balance of managing these diverse elements without stifling the creativity and drive that sparked its research efforts in the first place. It's this delicate equilibrium between control and freedom that often separates the exceptional from the merely competent. Four, financial skill, the art of mastering profit. In the intricate dance of production, marketing, and research, the terms profit and profit margin frequently emerge as central themes. For a sprawling enterprise with a diverse product lineup, pinpointing the cost of each product relative to others is no simple feat. Costs beyond raw materials and direct labor are often distributed across multiple products, sometimes all of them. However, companies endowed with exceptional financial prowess enjoy distinct advantages. By accurately assessing the profitability of each product, these firms can direct their efforts where they yield the most significant returns. They possess an intimate understanding of all cost elements, not just in manufacturing, but also in selling and research. This detailed knowledge illuminates even minor phases of company operations, revealing opportunities for cost reduction through technological innovations or optimized workforce assignments. Perhaps most crucially, outstanding financial acumen equips a company with an early warning system. Skillful budgeting and accounting enable swift detection of unfavorable trends that could jeopardize profit margins, allowing for timely corrective actions. This proactive approach helps avoid the unpleasant surprises that have unsettled investors in many firms. Moreover, superior financial management doesn't just stop at avoiding pitfalls. It often leads to more strategic capital investments that promise the highest returns on the company's investment capital. Effective control of receivables and inventory, especially vital during periods of high interest rates, is another hallmark of financial expertise. To sum up, a company that excels in financial skill embodies several key attributes. 1. It operates as a low-cost producer in its field, demonstrating exceptional marketing and financial capabilities. 2. It manages to generate a steady profit stream by developing new, profitable products that balance the obsolescence of older ones, ensuring that even during challenging economic times, profits remain stable. 3. It maintains the ability to sell new products as profitably as its current offerings. This perspective represents a conservative investment approach, a model that, if not compromised by other dimensions, is likely to keep investors satisfied. But why focus on growth and new product lines when safety and stability seem sufficient? In a world where change accelerates, standing still is not an option. A company must either grow or decline. Embracing growth is not just about seizing opportunities. It's a defensive strategy to ensure continued relevance and success. Companies that fail to innovate and adapt will inevitably lag behind, as rapid technological advancements, shifting social norms, evolving consumer habits, and new regulatory demands reshape even the most established industries. In the fast-paced arena of modern business, growth isn't just beneficial, it's essential for survival. Chapter 2, the second dimension, the people factor. In the realm of conservative investment, the first dimension is straightforward. It hinges on exceptional managerial competence in production, marketing, research, and financial controls. This dimension captures a snapshot of a company's current performance, a reflection of results achieved. But beyond this surface, there lies a deeper layer, the second dimension, which unveils the true engine behind these results and, crucially, the force that will drive future success. At its core, this dimension is all about people. Edward H. Heller, a trailblazing venture capitalist whose insights have significantly shaped the ideas in this book, coined the term vivid spirit to describe the kind of individual who merits substantial financial backing. He believed that every remarkable corporation is propelled by a distinct entrepreneurial personality, someone with the drive, creativity, and expertise to make the company an exceptional investment. Heller's perspective proved accurate in the world of small startups that evolved into thriving enterprises. Yet as these companies expand, Heller's idealism must be tempered by the wisdom of another sharp businessman who questioned the prudence of investing in companies led by close friends. This businessman noted, "My friend is brilliant and always right, but in a small company, that might be acceptable. As the company grows, everyone needs to be right sometimes." Herein lies the essence of the second dimension of conservative investment, a visionary CEO who not only pursues long-term growth, but also empowers a highly skilled team across various divisions. These team members should work collaboratively toward clear corporate objectives, avoiding internal power struggles. An essential goal for investment success is for top management to identify and cultivate promising juniors who can eventually replace senior leaders. This process should extend down the organizational hierarchy, ensuring that every level fosters and prepares the next generation of leaders. Does this imply that a company destined for conservative investment should exclusively promote from within and shun external hires except at entry-level positions? Not necessarily. Rapidly growing companies often need to fill roles quickly, and certain specialized skills may not be available internally. External hiring can also introduce fresh perspectives, challenging the status quo and driving innovation. However, companies with true investment potential generally favor internal promotion. These organizations develop unique policies and practices tailored to their needs. Integrating newcomers, especially at higher levels, can be costly and disruptive. Although no hard statistics prove this, it's often observed that top executives hired from outside tend to leave after a few years. Investors should be wary of companies that frequently bring in external executives. Such instances often signal underlying issues within the existing management team, despite potentially strong financial performance. While a new leader might eventually stabilize the organization, the rebuilding process can be long and fraught with risk. If an investor encounters this scenario, it's prudent to reassess their investment strategy to ensure it's grounded in solid principles. A useful indicator for investors is the disparity in top management salaries disclosed in annual proxy statements. A significantly higher salary for the CEO compared to other top executives could be a red flag. In contrast, a more balanced compensation structure suggests a more cohesive management team. For optimal investment results, it's not enough for management to merely collaborate effectively and handle internal promotions. The presence of those vivid spirits, Heller described, individuals with the ingenuity and determination to push beyond the status quo, is crucial. These exceptional people are rare, but their impact is profound. Take Motorola, for example. In 1967, anticipating rapid growth, Motorola launched its Executive Institute in Oracle, Arizona, to address future management needs. This institute, designed to train promising employees beyond their current roles, proved its worth beyond initial skepticism. By mid-1974, the institute had developed around 400 individuals, some rising to vice presidential roles, demonstrating that even companies with high growth rates can cultivate exceptional talent internally without the risks associated with frequent external hiring. Just as individuals have unique personalities, corporations have distinct ways of operating, shaped by their histories and the personalities that have led them. Successful companies often possess unique policies that set them apart. While individual traits remain stable, a company's methods evolve with new leadership. Nevertheless, three core elements are essential for a company's shares to be deemed worthy of long-term conservative investment. Element 1. Embracing change in a rapidly evolving world. In today's fast-paced world where change is the only constant, a company must continually adapt or risk becoming obsolete. The key to thriving in this dynamic environment is not just to keep pace, but to stay ahead by challenging the status quo constantly. This means reevaluating every accepted practice and method to ensure they remain the best options available. Rigid adherence to outdated practices, no matter how successful they once were, can lead to stagnation and decline. Take Dow Chemical Company as a prime example of how embracing change can yield extraordinary results. Recognizing the need for agility, Dow restructured its management into distinct geographical units: Dow USA, Dow Europe, Dow Canada, etc. This innovative approach allowed for quicker responses to local issues and bypassed the inefficiencies of a monolithic bureaucracy. According to Dow Europe's president, it's their sister companies around the world that drive the innovations and gains that propel them to the forefront of their industry. Dow's willingness to innovate didn't stop there. They took the bold step of establishing a wholly owned bank in Switzerland to support their export customers, a risk that paid off by significantly strengthening their financial base. This move exemplifies how proactive, rather than reactive, strategies can lead to success. Furthermore, Dow's early and significant investment in pollution control serves as another testament to their forward-thinking approach. They went beyond mere compliance by involving middle management in the quest for profit-driven solutions to environmental challenges. This strategy not only helped Dow achieve groundbreaking successes in pollution reduction, but also earned them praise from environmental groups and mitigated community opposition, often at minimal cost or even at a profit. In essence, Dow Chemical's story illustrates that companies must embrace change and innovation, not out of necessity alone, but as a deliberate strategy to remain competitive and successful in an ever-evolving world. Element 1. Element 2. The art of cultivating a great workplace. In our fast-paced world, where we often trade countless hours for a paycheck rather than pursuing our own pleasures, a company's ability to make work feel worthwhile can be transformative. It's not just about slogans or glossy brochures. It's about creating a genuine sense of value and belonging for every employee, from the newest hire to top executives. The crux of this effort lies in moving beyond mere rhetoric to ensuring that every employee feels respected and valued. Imagine the impact of a company where employees are not only acknowledged but treated with real dignity. For instance, a notorious claim in the press once accused a major corporation of forcing its workers to eat with grease-stained hands due to inadequate washroom facilities. Whether true or not, such accusations highlight the critical importance of maintaining a decent work environment. If verified, this lapse alone would tarnish the company's reputation and make it a risky investment for any discerning investor. True employee loyalty isn't a one-size-fits-all formula, but rather a mosaic of strategies. Effective pension plans, profit-sharing schemes, and transparent communication can foster a positive work culture. Informing employees not only about what is happening, but why, reduces friction and builds trust. Equally important is a system where grievances can be voiced without fear of retaliation. Quick resolution of issues prevents simmering discontent from escalating into major problems. Consider Texas Instruments' People Effectiveness Program, a shining example of how fostering employee involvement can yield extraordinary results. This initiative began in the 1950s, when manual semiconductor production was ripe for individual input. Employees were encouraged to propose improvements, earning rewards and recognition for their contributions. As technology evolved and mechanization took over, the focus shifted from individual to team-based contributions. Workers set ambitious goals, even proposing to shorten breaks to meet targets, driven by peer pressure and a genuine stake in the company's success. The remarkable outcomes of this program are evident in Texas Instruments' performance metrics. Despite rising wages and falling semiconductor prices, Their People Effectiveness Index improved from 2.25% in 1969 to 2.5% by 1973. The company's goal to reach 3.1% by 1980 was ambitious, but it underscored a commitment to continual improvement and profitability. For investors, the lesson is clear. Companies that master the art of engaging their employees not only foster loyalty, but also achieve superior performance. While it's easy to describe successful programs in theory, implementing them requires careful planning and execution. Missteps in training or failure to genuinely involve employees can be disastrous. Conversely, well-executed programs create a competitive edge that can significantly benefit long-term investors. In essence, creating a great place to work isn't just about enhancing morale. It's a strategic advantage that can lead to greater productivity and financial success. Element 3. Embracing discipline for genuine growth. In our fast-paced world, standing still isn't an option for companies. They must either evolve or decline. The goal of growth isn't just about stacking up profits, it's about safeguarding against losses. Many companies boast about their commitment to growth, but talking the talk doesn't always mean walking the walk. A true growth-oriented company isn't fixated on squeezing every last cent of profit out of each period. Instead, its focus is on balancing immediate profits with the strategic investments needed for future expansion. This could mean reinvesting profits into new products, innovative processes, or expanding operations, even if it means sacrificing short-term gains. It might involve hiring and training new talent, or prioritizing customer loyalty by meeting urgent needs over maximizing immediate profits. The hallmark of a genuine growth company is its dedication to long-term value, rather than just appearing growth-focused. For the discerning investor, the key is to look beyond superficial claims and assess whether the management is truly committed to enhancing the company's future profitability. A company that only pays lip service to growth disciplines, or one that falters in executing them. Like spending on research, but failing to translate it into meaningful advancements, will likely disappoint. True growth requires both the will to commit to these principles and the skill to implement them effectively. Chapter 3. The Third Dimension. Investment characteristics of some businesses. In the realm of conservative stock investment, the third dimension reveals the underlying traits of a business that pave the way for sustained above-average profitability. While the first dimension focuses on the company's operational excellence, and the second on the caliber of its leadership, the third dimension delves into the intrinsic characteristics of the business itself that contribute to long-term financial success. Why does above-average profitability matter so much to investors? It's not merely about reaping higher returns. It's also about safeguarding what's already been earned. Growth, though a sign of a thriving business, comes with its own set of expenses. Research, product development, and scaling up operations all require substantial investment. During inflationary times, maintaining profitability becomes crucial. Rising costs can often be passed along to consumers, but the timing is rarely perfect. Businesses with broad profit margins can absorb these costs better than those with thinner margins, which might be pushed into loss if they can't adjust prices accordingly. Profitability itself can be assessed in various ways. Companies typically measure it by return on invested assets, essentially, how much return they generate from their capital. For investors, comparing total earnings to total assets can be misleading, especially given how the costs of capital equipment have soared in recent decades. Therefore, profit margins relative to sales can offer a clearer picture. However, a company with a high sales-to-assets ratio might still outperform one with a higher profit margin, but slower sales turnover. For investors, a strong profit margin provides a buffer against rising costs and competitive pressures, offering a degree of safety. In today's dynamic business landscape, companies that achieve above-average profit margins for an extended period often attract competitors. Much like a jar of honey attracts insects, a profitable business will draw interest from potential rivals. To protect their profit margins, companies must either monopolize the market, an often fleeting advantage, or operate with such superior efficiency that competitors are deterred. One significant characteristic contributing to sustained profitability is economies of scale. For instance, a company producing 1 million units a month will often have lower production costs per unit compared to a smaller company. However, scale alone isn't a silver bullet. Larger companies must navigate the complexities of managing vast operations without falling prey to inefficiencies and bureaucratic delays. Leadership in a field, especially in terms of profitability, often remains stable as long as management remains competent. For example, despite numerous attempts by competitors, General Electric has consistently outperformed Westinghouse, and IBM has maintained dominance in the computer market despite fierce competition. The key to maintaining such dominance is a combination of being first with innovative products and continuing to deliver exceptional value. Consider the pharmaceutical industry. The first company to introduce a breakthrough drug can capture a significant portion of the market, often making the lion's share of the profits. Subsequent entrants face diminishing returns as they struggle to capture smaller market shares. This dynamic underscores the advantage of being an early mover in establishing a dominant position. Campbell Soup Company provides another illustration of the benefits of scale. As the largest soup canner in the U.S., Campbell's benefits from reduced production costs, efficient logistics, and favorable shelf space allocation. Despite these advantages, Campbell's must still contend with rising production costs and competition from homemade soups, showing that even with scale, profitability is not guaranteed. Technological fields also offer insights into profitability dynamics. Companies excelling in fields requiring multiple scientific disciplines often enjoy a competitive edge. For example, firms combining electronics with nucleonics or specialized chemistry can establish significant barriers to entry, giving them a sustained profitability advantage. This interdisciplinary approach is becoming increasingly valuable as technology evolves. Finally, marketing strategies can also secure lasting profit margins. A company that creates a strong customer habit of specifying its products due to their quality and reliability can enjoy long-term profitability. However, this is only possible if the company serves many small customers, making it difficult for competitors to target them individually. In conclusion, the third dimension of conservative investing highlights the importance of intrinsic business characteristics that support long-term profitability. It's not enough to have excellent management or operational efficiency. A company must also possess inherent traits that protect and sustain its profitability against competitive and economic pressures. The crucial question to consider is, what unique advantages does the company have that others cannot easily replicate? If a company's success can be easily imitated, its stock may be undervalued, but it fails to meet the criteria for this dimension of conservative investment. Chapter 4. The fourth dimension, the price of a conservative investment. In the realm of stock investing, the fourth dimension is the price-earnings (PE) ratio. This metric, calculated by dividing the current stock price by the earnings per share, is crucial for determining if a stock is properly valued. Yet this seemingly straightforward number often leads investors, both seasoned professionals and novices alike, into a labyrinth of confusion and misjudgment. Why does the PE ratio often mislead? Many investors lack a clear grasp of what drives significant price fluctuations. This ignorance has led to colossal losses, as investors end up purchasing stocks at inflated prices or, worse, selling stocks prematurely. The repercussions extend beyond individual portfolios. Recurring poor investments can hamper the ability of deserving companies to secure financing, which, in turn, can negatively impact everyone's standard of living. Despite this, there are investors who thrive thanks to their understanding of fundamental investment principles or sheer luck. These successful individuals often hold on to high-quality stocks even when their PE ratios appear elevated compared to past norms. This patience and discernment can result in remarkable returns. The crux of the matter is understanding what drives sharp price changes. Essentially, significant fluctuations in a stock's price relative to the broader market are often due to altered appraisals by the financial community. To illustrate, consider Company G. 2 years ago, it was viewed as mediocre, trading at $10 per share with earnings of $1 and translating to a P/E ratio of 10. However, over the past 2 years, while many of its peers faced declining profits, Company G flourished, boosting its earnings to $1.82 per share. This improvement, coupled with the financial community's renewed appraisal of its performance, drove its P/E ratio up to 22, pushing its stock price to $40, a 400% increase. Understanding appraisals is key. These are inherently subjective and reflect the prevailing beliefs of investors, not necessarily the actual performance of a company. Consequently, a stock's price may diverge significantly from its intrinsic value based on the shifting perceptions of the financial community. This brings us to an intriguing paradox. If price changes are driven by subjective appraisals, why should we consider the other dimensions of a stock's value? The answer lies in timing and market psychology. Stocks often trade at inflated or deflated prices based on prevailing sentiments rather than fundamentals. Over time, these discrepancies tend to correct themselves, but investors must navigate the turbulent waters of temporary overvaluation or undervaluation. Stocks with initially high P/E ratios can still be good investments if the fundamentals are strong. A company's continued growth may eventually justify a high valuation, despite short-term market fluctuations. Conversely, stocks trading at unsustainable highs due to unrealistic expectations may eventually plummet as the bubble bursts. The risk scale in investing ranges from the lowest to the highest based on how well a company aligns with the first 3 dimensions of investment quality and its current appraisal. Companies with strong fundamentals but high P/E ratios might still be worth holding if they are likely to grow into their valuations. However, stocks with poor fundamentals and inflated appraisals are highly speculative and dangerous, potentially leading to substantial losses. At the extreme end, stocks with appraisals far exceeding their actual value pose the greatest risk. Historical examples abound where companies with overhyped valuations faced dramatic declines when reality caught up with expectations. Understanding the dynamics of price-earnings ratios and their underlying appraisals is essential for navigating the complexities of stock investing. While minor price fluctuations might be temporary, significant changes reflect deeper shifts in market perceptions, which can profoundly impact investment outcomes. Chapter 5. Navigating the 4th dimension of stock valuation. Up to now, our exploration of stock evaluation might have suggested a rather simplified view, assessing a stock as if it were an isolated entity, free from the complexities of its surroundings. However, this is a significant oversimplification. The true valuation of a stock emerges from a nuanced interplay of 3 distinct appraisals: the general attractiveness of common stocks as a whole, the specific industry to which the company belongs, and the unique qualities of the company itself. Let's delve into the industry appraisal aspect first. It's a well-known fact that over extended periods, the price-earnings ratio that the financial community is willing to assign to an industry can experience dramatic fluctuations. For instance, consider the electronics sector during its early years. Companies specializing in electronic tubes, then the cornerstone of electronics, boasted sky-high price-earnings ratios. However, as semiconductors emerged and revolutionized the field, these ratios plummeted, reflecting a shift in the market's focus. A similar fate befell manufacturers of magnetic memory devices. What is often less apparent is how industry perceptions can shift not solely due to tangible technological changes, but also because of the financial community's shifting focus. Take the chemical industry as an example. From the depths of the Great Depression until the mid-1950s, U.S. chemical companies enjoyed high price-earnings ratios, buoyed by an image of endless innovation. Their reputation was akin to an endless conveyor belt, scientists concocting marvels in labs, which then transformed into revolutionary products like nylon and synthetic rubber. Yet, as the 1960s dawned, this image morphed. The chemical industry began to resemble more mundane sectors like steel or paper, known for selling bulk commodities based on technical specifications. The once coveted stocks now languished, their ratios dipping as price competition intensified and profit margins squeezed. This shift wasn't due to any dramatic alteration in the industry's fundamentals, but rather a change in the financial community's focus. Despite the challenges, the chemical industry's core strengths persisted. The capacity to innovate and develop new, high-margin products remained unchanged. The decline in stock value during the 1960s didn't reflect a deterioration in industry fundamentals, but rather a temporary shift in perception. In 1973, however, a new narrative emerged. The financial community began to view the chemical industry through a fresh lens, recognizing the potential for growth amid a scarcity-driven economy. The challenge for investors was to determine if this renewed optimism was justified and whether the stock prices had risen in line with the new perspective. History is replete with such shifts in industry perceptions. In 1969, computer peripheral stocks were hot commodities, with the belief that these companies had boundless prospects. But as time passed, the financial community recognized the challenges facing small companies in this space and the competitive pressures from major manufacturers. Similarly, in the late 1960s and early 1970s, franchise stocks experienced a meteoric rise, only to face a reality check later. The underlying issues in the franchising business were present all along, but were overshadowed by a prevailing image of relentless growth. The investor's dilemma remains constant. Is the current appraisal of an industry more or less favorable than the underlying economic realities? This question can confound even the most seasoned investors. For instance, in December 1958, when Smith, Barney & Co. ventured to offer shares of AC Nielsen Co., a service company with no tangible products, the market was hesitant. The concept of valuing a service company as opposed to a product-based one was new and unsettling. Yet, as the company's fundamentals proved sound, perceptions shifted, and service companies began to be seen as lucrative investments. In essence, the conservative investor must remain vigilant, constantly evaluating whether the prevailing financial community appraisal aligns with the industry's fundamentals. Only by discerning these nuances can one navigate the intricate dance of stock valuation and secure a reasonable outlook on the long-term market trends. Chapter 6. Delving deeper into the fourth dimension. In the labyrinth of stock valuation, the financial community's view of a company's unique characteristics can often overshadow the industry-wide perspective. This nuanced assessment plays a pivotal role in the price-earnings ratio, potentially swaying it more dramatically than the sector in which the company operates. The desirable traits of a company, as discussed in our exploration of the first three investment dimensions, are critical benchmarks. When the financial community's evaluation aligns closely with these characteristics, the price-earnings ratio typically soars. Conversely, if a company's traits fall short of these standards, its ratio tends to decline. Savvy investors discern whether a stock is undervalued or overvalued by astutely contrasting the real facts about the company with the prevailing financial image. Often, investors stumble by applying overly simplistic mathematical comparisons. Take two companies with projected 10% annual growth rates. If one stock trades at 10 times earnings while the other at 20, the former appears more affordable. But is it? This seemingly straightforward comparison can be misleading. The ostensibly cheaper stock might be burdened by a leveraged capital structure, interest and preferred dividends that must be covered before common stockholders see any benefit. Such financial strain could jeopardize the projected growth. Moreover, while both stocks may promise similar growth rates, unexpected hurdles might derail the estimates for one more than the other. The risk of relying on basic price-earnings ratio comparisons is even greater when stocks seem equally poised for growth. Imagine two stocks expected to double their earnings over 4 years, both currently trading at 20 times earnings. If stocks with no growth prospects are priced at 10 times earnings, the growth stocks seem overpriced. Yet, 4 years later, if one stock maintains its growth trajectory while the other faces stagnation, the latter's price-earnings ratio might plummet despite having met its earnings targets. This scenario illustrates a crucial investment principle. The further into the future a stock's profits are expected to grow, the higher the price-earnings ratio an investor might justify. However, this principle must be approached with caution. The fluctuations in price-earnings ratios stem not from actual outcomes, but from the financial community's prevailing beliefs. During times of market euphoria, a stock might command a sky-high price-earnings ratio based on optimistic growth forecasts. Yet, if the company faces a temporary setback, the initially justified high ratio may become unjustified. Conversely, during periods of market pessimism, the undiscounting of even stellar investments can present patient investors with enticing opportunities for significant long-term gains. A vivid illustration of this principle occurred on March 13, 1974. The day before, Motorola's shares closed at 48 foit. After an announcement that Motorola would exit the television business, selling its U.S. plants and inventory to Matsushita, the stock surged to 60, a nearly 25% gain. While the news about Motorola's exit from the loss-making television segment was expected to boost the stock, the real driver was more complex. A significant number of investors had long recognized Motorola's communications division as a high-quality investment, despite the company's overshadowed television business. The sale led to a re-evaluation, with investors eager to correct the distorted image and bet on the company's true value. Despite the initial surge, those who rushed to buy Motorola might not have been entirely wise. In the weeks following the news, the stock lost its immediate gain, exacerbated by rising short-term interest rates and a bearish market sentiment. This highlights a subtle but potent investment risk: the tendency to ascribe undue value to a stock's previous trading range. This habit can lead to hasty decisions, either overvaluing or undervaluing a stock based on past prices rather than current fundamentals. Moreover, the general stock market outlook is another dimension influencing stock prices. For instance, the investment community's view of stocks can fluctuate dramatically based on economic conditions. During the late 1920s, a prevailing New Era optimism led to excessive stock prices, which plummeted into the Great Depression when reality set in. Conversely, in the late 1940s, stocks were undervalued despite strong earnings due to fears of an impending economic downturn, leading to one of the longest bull markets when these fears proved unfounded. In summary, the fourth dimension of stock investing encompasses the intricate interplay of a company's appraisal, the industry's context, and the general market sentiment. To gauge whether a stock is genuinely attractive, investors must evaluate how the financial community's current perceptions align with reality and anticipate shifts in broader financial factors, such as interest rates, that influence stock levels. This holistic approach can reveal opportunities amidst market fluctuations and lead to prudent investment decisions. Part 3. Developing an Investment Philosophy. In tribute to Frank E. Block. This section of the book is dedicated to Frank E. Block, CFA, whose remarkable vision and unwavering dedication have shaped the very essence of financial analysis. Originally published at the behest of the Institute of Chartered Financial Analysts, this work owes its existence to the C. Stuart Shepard Award, an accolade bestowed upon Block in recognition of his monumental contributions. Through his relentless efforts and visionary leadership, Block has played a pivotal role in elevating the Institute as a cornerstone of financial education, upholding ethical standards, and championing the advancement of financial analysts. His legacy is enshrined in the programs and publications he inspired, which continue to enrich and inform the field. Developing an Investment Philosophy. Chapter 1. The Genesis of a Philosophy. To grasp the essence of any disciplined investment strategy, one must first understand the goals it aims to achieve. At Fisher & Co., the mission is clear: to channel funds into a select group of companies that exhibit a unique blend of management prowess, enabling them to outpace industry growth rates in both sales and, more crucially, profits. This ambitious target is pursued with minimal risk relative to the growth potential. To meet Fisher & Co.'s rigorous standards, a company's must embrace a long-term vision, willingly trading short-term gains for substantial future rewards. Essential to this vision are two critical traits. First, the management must demonstrate exceptional day-to-day operational performance, ensuring that long-term policies are executed effectively. Second, they must exhibit a keen ability to identify and correct significant errors, whether arising from ambitious innovations or complacency from past successes. My belief in the unique characteristics of manufacturing companies has led me to focus Fisher & Co.'s investments predominantly in this sector. These enterprises leverage cutting-edge technology and superior business acumen to achieve their goals. My decision to concentrate solely on manufacturing investments stems from past experiences where deviations from this focus yielded unsatisfactory results. However, I remain convinced that these principles hold promise across various industries, retailing, transportation, finance, and beyond, when applied by experts in those fields. No investment philosophy emerges fully formed overnight. Mine, in particular, evolved over years of careful reasoning, observation of others, triumphs and failures, and perhaps most significantly, through the often painful process of learning from my own missteps. To convey the development of my investment approach, I will trace its origins back to its early formative years, illustrating the incremental steps that shaped this philosophy. Developing an investment philosophy. The birth of interest. My first brush with the stock market came at an unusually young age, ignited by a seemingly ordinary afternoon visit to my grandmother. Born into a family with many gone before me, my father was the youngest of 5, my mother the youngest of 8. By the time I arrived, I had only one grandparent left. This made me especially close to my grandmother, and it was during a visit to her when I was still in grammar school that my world expanded. An uncle stopped by to discuss his thoughts on business conditions for the coming year and how these would influence the stocks my grandmother owned. As he spoke, a new universe unfolded before me. The idea that by saving a little money, I could own a slice of the future profits of major companies was mesmerizing. If I made the right choices, the potential gains were thrilling. Here was a game that, if mastered, promised a level of excitement far beyond anything else I had encountered. When my uncle departed, my grandmother expressed regret that his visit had diverted her attention from me, fearing it held no interest for a child. But in truth, the hour had flown by like mere minutes, and I was captivated. It was only years later that I realized how limited her stock portfolio was and how superficial the conversation had been. But the spark of curiosity it ignited in me has never dimmed. During the roaring bull market of the mid-1920s, I dabbled in stocks, making a modest amount of money. My father, a physician wary of gambling, discouraged me, fearing it would lead to reckless habits. Yet my inclination was never toward gambling, but toward calculated opportunities. Reflecting on it now, those early forays into the stock market provided little in terms of profound investment wisdom, but they planted a lasting fascination that has shaped my life ever since. Formative experiences. Before the great bull market of the 1920s came crashing down, I had an invaluable experience that shaped my future in ways I could hardly imagine. In the academic year of 1927-28, as a first-year student at Stanford University's nascent Graduate School of Business, I found myself at the crossroads of theoretical learning and real-world insights. A quarter of our curriculum was dedicated to exploring the largest business enterprises in the San Francisco Bay Area. This was led by Professor Boris Emmett, whose unconventional background made him an extraordinary guide. Professor Emmett was not your typical academic. His expertise lay in rescuing struggling manufacturers squeezed by the onerous contracts of large mail-order companies. His role was to salvage these faltering companies, which endowed him with profound managerial insights. Our course was unique. It wasn't enough for companies to merely show us their operations. They had to engage with us, allowing us to probe deeply into their strengths and weaknesses under Professor Emmett's discerning questions. Seizing this rare opportunity, I managed to leverage my advantage by offering Professor Emmett rides to these companies. Although our conversations on the way there were limited, the return trips became a goldmine of candid observations and critiques. This was a treasure trove of real-world learning that I cherished deeply. On one memorable trip, we visited two neighboring manufacturing plants in San Jose. The John Bean Spray Pump Company, renowned for its orchard insecticide pumps, and the Anderson Barngrover Manufacturing Company, a leader in fruit cannery equipment. At that time, the concept of a growth company was still nascent. Yet, I instinctively sensed that these two companies had the potential for exceptional growth. Professor Emmett validated my intuition, a validation that proved prophetic as these companies expanded beyond their initial size. Beyond the tangible insights gained from these visits, I also absorbed a crucial lesson from Professor Emmett's experiences: the paramount importance of sales. Even the most efficient manufacturing processes or groundbreaking inventions are meaningless without a robust sales strategy. A successful business needs not only to produce, but to persuade and adapt to its customers' evolving needs. A concept that later crystallized into what I understood as marketing mastery. These formative experiences laid a solid foundation for my future endeavors, equipping me with invaluable knowledge and a keen understanding of the business world. Early lessons in the School of Experience. As the summer of 1928 drew near, and my inaugural year at the business school came to a close, an intriguing opportunity presented itself, one I felt was too good to pass up. Unlike the hundreds of students currently enrolled each year, my class was a modest cohort of 19, making it only the third graduating class in the school's history. The year before, just 9 students had graduated, with only 2 having a background in finance. Amidst the stock market's tumultuous excitement, these 2 were quickly recruited by investment trusts in New York. At the 11th hour, an independent San Francisco bank, which would later merge with Crocker National Bank, approached the school. They sought a graduate trained in investments. This was a golden chance for the school to establish a reputation for placing graduates in prominent positions. Unfortunately, there was no suitable graduate available at the time. After some negotiation, I convinced the school to send me, with the understanding that if I proved successful, I'd stay. If not, I would return and continue with my second-year courses, with the bank knowing the school hadn't promised a fully trained expert. In those pre-crash days, security analysts were known as statisticians. It wasn't until the stock market crashed, causing stock prices to plummet dramatically over 3 years, that the term statistician fell out of favor and security analyst took its place. Assigned to the investment banking division of the bank, I was tasked with a job that was both simplistic and, in my view, ethically dubious. Back then, there were no legal restrictions on banks engaging in brokerage or investment banking. My role was straightforward, but it lacked integrity. The bank's investment branch was focused on selling high-interest new bond issues, earning significant commissions as part of underwriting syndicates. No effort was made to assess the quality of these bonds or stocks. Instead, in a seller's market, the bank eagerly accepted any syndicate share offered by their New York partners or large investment houses. The bank's security salesman would then present to their clients the illusion of a robust statistical department capable of detailed analysis. In reality, my so-called security analyses involved merely paraphrasing information from established manuals like Moody's or Standard Statistics. Any company showing substantial sales volume was automatically deemed well-managed, simply due to its size. While I wasn't directly instructed to push customers toward the bank's current offerings, the environment subtly encouraged this kind of biased analysis. Building the basics. It wasn't long before the superficial nature of the whole procedure began to gnaw at me. I was convinced there had to be a better approach. Fortunately, I had a boss who not only understood my concerns, but also supported my experimental leap into uncharted territory. In the fall of 1928, amidst a frenzy of speculative interest in radio stocks, I seized the moment. I introduced myself as a representative of the bank's investment arm to various buyers in San Francisco's radio department. I was eager to gather opinions on the 3 major competitors in the industry. To my surprise, the feedback was remarkably consistent. Particularly enlightening was a conversation with an engineer who had worked for one of these companies. His insights were gold. Philco, a company unfortunately not listed on the stock market, had crafted models with an irresistible market appeal. Their efficient manufacturing allowed them to capture market share and profit handsomely. RCA was holding its ground, but another company, a darling of the stock market at the time, was slipping fast and showing signs of trouble. Despite this valuable information, none of it directly pertained to the bank's operations, as we didn't handle radio stocks. However, my evaluative report had potential, especially for the key bank officers who were personally invested in these speculative stocks. Surprisingly, Wall Street firms discussing these hot issues had failed to mention the brewing troubles. As the stock market ascended to dizzying heights over the next year, I watched with growing interest as the stock I had flagged for trouble continued to falter amidst the general market surge. This experience was a cornerstone in my investment philosophy. Reading financial records alone is insufficient. It's crucial to glean insights from those with direct experience. Yet I hadn't yet grasped the next step, understanding the individuals running a company. It was important to either meet them personally or find someone you trust who knows them well. As 1929 unfolded, the market's wild exuberance convinced me more than ever of the instability lurking beneath the surface. Stocks climbed on the dangerous belief that we were in a new era, where rising per-share earnings were an inevitability. However, when I examined America's core industries, many seemed precariously balanced. In August 1929, I issued a report predicting the onset of the greatest bear market in a quarter century. I wish I could say that I capitalized on this foresight and reaped great rewards. The reality was quite different. Despite my strong belief that the market was dangerously high, I was lured by its allure. I sought out cheap stocks that hadn't yet inflated. With the small profits from past transactions, savings from my salary, and money earned in college, I invested a few $1,000s in 3 stocks I thought were undervalued. One was a leading locomotive company, its low price-earnings ratio tempting me. Given the cyclical nature of the railroad industry, it was clear what would happen to its sales and profits as the impending depression hit. The other 2 investments were in local billboard and taxicab companies, also at low price-earnings ratios. Despite my success with radio stocks, I didn't take the same approach with these local businesses. I failed to investigate or meet the people behind these companies, even though doing so would have been relatively easy. As the depression deepened, the reasons for their low price-earnings ratios became glaringly apparent. By 1932, the market value of these shares had dwindled to a mere fraction of my original investment. The Great Bear Market. In the annals of investing, there's a lesson that only the harshest of teachers can impart: the Great Bear Market. Fortunately for me, this lesson came wrapped in a deep-seated aversion to losing money. I've always believed that the key difference between a fool and a sage is simple. The sage learns from his blunders, while the fool stubbornly repeats them. To avoid the latter fate, I scrutinized my past errors with painstaking care. The collapse of 1929 was a crucible that forged a new understanding of investing. I discovered that a low price-earnings ratio, while seemingly enticing, could often signal underlying weaknesses rather than hidden gems. It dawned on me that the true measure of a stock's value isn't its current price relative to this year's earnings, but its future earnings potential. If I could hone the skill of forecasting those future earnings with reasonable accuracy, I would not only avoid losses, but also seize remarkable opportunities for profit. The harsh reality of my performance during the Great Bear Market drove this point home. Although I had astutely predicted the collapse of the bull market and accurately gauged its impact, this foresight brought me little benefit beyond a fleeting boost to my reputation among a select few. The critical lesson was clear. Intellectual insight and correct reasoning about investment strategies mean nothing if they aren't translated into actionable steps. True success lies not just in understanding, but in execution. A chance to do my thing. In the spring of 1930, I took a leap. one that, unbeknownst to me, would set the stage for my future investment philosophy. At just 22, a regional brokerage firm made me an offer I found almost impossible to refuse. The salary was tempting, and the role was a world away from my unsatisfying stint as a statistician in investment banking. This new job was a breath of fresh air. I would have the freedom to delve into the stock market, identifying which individual stocks were ripe for buying or selling based on their unique characteristics. My task was to draft insightful reports to help the firm's brokers drum up profitable business for their clients. The timing was intriguing. Herbert Hoover had just proclaimed that prosperity is just around the corner, a statement that seemed almost ironically optimistic in the wake of the 1929 market crash. The firm's payroll had shrunk from 125 to 75 employees, and they were eager to bring me on as their 76th recruit. They were bullish, but I was decidedly bearish, convinced that the bear market still had a long way to run. I set a condition before accepting their offer. While they could fire me if my work didn't meet their standards, they had to guarantee that my junior status wouldn't be a factor if further layoffs were necessary due to a worsening financial climate. They agreed, and thus began my journey into the investment world with a chance to truly make my mark. From disaster, opportunity springs. As an employer, I couldn't have asked for a more amiable group. Yet, the ensuing 8 months proved to be one of the most invaluable business education periods of my life. Witnessing firsthand how not to conduct an investment business became a crash course in what pitfalls to avoid. By the end of 1930, as the stock market continued its relentless descent, our firm's position grew increasingly precarious. Then, just before Christmas, we were dealt a crushing blow. The entire firm was suspended from the San Francisco Stock Exchange for insolvency. For my colleagues, this was a dire setback, but for me, it was a stroke of fortune. In the midst of the economic wreckage, a silver lining appeared. I had long nurtured the idea of starting my own business, envisioning a future where I could offer clients expert investment management. Back then, terms like investment counselor or investment advisor were unheard of, so I had to imagine my venture in more abstract terms. The gloom of January 1931 had driven almost everyone in the financial sector into retreat. The only job available to me was a mundane clerical role that offered little excitement. Yet, had I properly assessed the situation, I would have seen that this was precisely the right moment to launch my new business. The relentless bear market had left investors disillusioned with their current brokers, making them more open to fresh, innovative approaches. Additionally, as the economy reached rock bottom in 1932, many prominent business figures found themselves with time on their hands, making them more receptive to new ideas. One of my most significant clients, whom I still serve today, was a prime example of this serendipity. He later confided that, on the day I approached him, he had finished reading the sports section of the newspaper and was looking for a way to pass the time. If I had come a year later, he admitted, I would have never made it past his secretary. Thus, in the midst of disaster, opportunity had not just emerged. It had practically knocked on my door. A foundation is formed. In the heart of a bustling city, amidst the economic turmoil of the early 1930s, a small office became the birthplace of a remarkable journey. Picture a space so compact it barely accommodated a desk, a chair, and a second seat, a haven of glass partitions and minimalistic charm. For the princely sum of $25 a month, I secured this modest enclave, complete with the luxury of free local calls and a touch of secretarial help from the landlord's receptionist. The setup was sparse and the overheads were low. Beyond rent, my only financial commitments were for stationery, postage, and the rare long-distance call. The ledger from those days tells a stark story. In 1932, after countless long hours, I eked out a meager profit of $2.99 a month. The following year, amidst ongoing hardships, things improved. My earnings soared to just over $29 a month, a staggering increase of nearly 1,000%. These earnings were barely enough to compare with the income of a newsboy peddling papers on street corners. Yet, The true value of those years lay not in the immediate financial returns, but in the foundation they provided. They forged the bedrock of an incredibly profitable business and fostered a loyal clientele by 1935. In hindsight, it might seem like a stroke of genius to start a business in such bleak times, but the truth was far simpler. The unattractiveness of available job opportunities drove me to this venture. What seemed like a struggle was, in reality, a pivotal step towards a future brimming with promise. Chapter 2. Learning from experience. While I was working at the bank, a captivating news story from my Stanford Business School days resurfaced. In 1928, the John Bean Manufacturing Co. and the Anderson Barngrover Manufacturing Co. had joined forces with Sprague Sells Corporation, a prominent vegetable canning manufacturer from Hoopeston, Illinois. This merger gave birth to the Food Machinery Corporation. The year 1928 was marked by a frenzy of stock speculation, with the nation caught in a whirlwind of stock market mania. The Food Machinery Corporation's stock was no exception, riding the wave of enthusiasm. With demand soaring, the stock price climbed as well, reflecting the feverish appetite of investors. That same year, the San Francisco Stock Exchange saw at least 20, if not double that, new stock issues flooding the market, often with dubious value. One firm, for instance, was selling shares in a company purportedly bottling water from a distant spring, but the only supporting documents were a snapshot of the spring and scant personal connections with the sellers. The Food Machinery Corporation stock, priced at 20.5, was caught up in this tidal wave of excitement, indistinguishable from other speculative ventures of the time. The market's exuberance was mirrored in the activities of stock pools, which were legal at the time. A local group, led by an enthusiastic but inexperienced organizer, embarked on a scheme to manipulate the Food Machinery shares. Their strategy was straightforward: buy and sell the stock among themselves, driving up the price through a cycle of inflated trading. This self-propagating excitement eventually attracted outside buyers, further inflating the stock's value. While some manipulators in the market were seasoned professionals, this particular pool lacked the sophistication and finesse of the more experienced operators. As autumn of 1929 approached and the stock market began its dramatic fall, the pool had managed to accumulate a substantial portion of the Food Machinery shares, driving the price to a peak in the high 50s. Despite this, the public's involvement had dwindled, leaving most of the stock in the hands of insiders. The broader economic downturn took a severe toll on the market. Companies that had gone public in the 1928 frenzy faced a grim fate, with many succumbing to bankruptcy and the rest struggling with mounting losses. Food Machinery was not immune to this collapse. By the time the market hit its nadir in 1932, and again when the banking system faltered alongside Franklin D. Roosevelt's inauguration in March 1933, Food Machinery shares had plummeted to between $4 and $5, with the lowest recorded price at $3 for 100 shares. This turbulent chapter serves as a stark reminder of the perils of speculation and the often harsh reality of market corrections. Food Machinery, a hidden gem in the investment landscape. In the depths of the Great Depression, as 1931 unfolded, I found myself scouring for an investment opportunity to breathe life into my fledgling business. Amidst this search, Food Machinery emerged as a beacon of potential, offering an investment landscape that seemed ripe for exploration. Having learned a hard lesson from past ventures, where failing to scrutinize the management of local companies resulted in significant losses, I vowed to never repeat that mistake. The more I engaged with the team at Food Machinery, the more my respect for them grew. This company, in the throes of economic adversity, appeared to embody the very essence of the opportunities I sought for the future. Let me delve into what made Food Machinery stand out so remarkably back then. Despite its relatively modest size, Food Machinery was a titan in its field. It dominated the global market with unparalleled quality across its three main sectors. This scale of operation endowed the company with a significant advantage. As an efficient and large-scale manufacturer, it enjoyed the benefits of low-cost production, From a competitive standpoint, the company's marketing position was formidable. Its products were highly esteemed, and it maintained control over its sales operations. Its canning machinery lines had already established a significant presence, creating a reliable market for spare and replacement parts. What truly set food machinery apart, however, was its innovative spirit. For a company of its size, its engineering and research department was remarkably inventive. They were pioneering several groundbreaking products, such as the industry's first mechanical pear peeler and peach pitter, as well as a process to enhance the visual appeal of oranges. These innovations were set to transform the industry, potentially unlocking a significant new revenue stream. In my experience, few companies had at that time such a promising horizon of new products relative to their size. Yet, even with these appealing attributes, I understood that the mere presence of innovative products was not a guaranteed path to success. The quality of the people behind the company was equally critical. In business, it's not enough to excel at daily operations. Long-term planning and growth vision are just as crucial. The best managers possess both the skills to handle daily tasks with precision and the foresight to steer the company toward future success without courting unnecessary risks. Integrity, too, was a non-negotiable trait. The management's honesty and commitment to ethical standards were essential. As evidenced by the tumultuous pre-1929 financial era, a lack of integrity can lead to significant losses for shareholders. Effective management must demonstrate genuine stewardship and foster a loyal and motivated team to drive the company forward. Food machinery's leadership during those dark days was exemplary. John D. Crummy, the president, was not only an efficient and respected leader, but also a man of profound personal integrity. His chief engineer was a visionary designer with a knack for securing valuable patents. Additionally, Crummy's son-in-law, Paul L. Davies, despite his initial reluctance, joined the company and eventually played a pivotal role in its expansion and prosperity. This was a company that, despite its size, exhibited rare and desirable characteristics in the investment world. Its management was outstanding, its competitive position strong, and its future prospects promising. Even if some of its innovations didn't come to fruition, the company's inherent strengths ensured a bright and successful future. Zigging and zagging, the art of investment mastery. To truly strike gold in the investment world, one must master the art of zigging while the financial community is busy zagging. The greatest fortunes are often reserved for those who can recognize when the crowd is headed in the wrong direction and boldly take the opposite path. Consider the Food Machinery Corporation during the 1932 to 1934 period. A classic example of this principle in action. At that time, the company was buried beneath a mountain of skepticism, mistaken for just another speculative flop amidst a market frenzy. This widespread doubt created an opportunity to acquire shares at a bargain basement price, a scenario ripe for those who could see beyond the prevailing gloom. Training oneself to resist the gravitational pull of the crowd and instead zig when others zag is, in my view, a cornerstone of investment success. The rush of excitement I felt as I scrutinized the undervalued Food Machinery Corporation is difficult to put into words. My senses were on high alert as I envisioned what this overlooked gem could mean for both my modest finances and the fledgling business I was nurturing. The timing seemed perfect. Just as a spring tightly compressed is poised to spring forth, the years from 1933 to 1937 were set to see stocks gradually climb before erupting into a full-blown bull market. This surge was followed by a significant dip in 1938 and a subsequent rebound the next year. With an unshakable belief that food machinery would outshine the broader market, I eagerly bought every share I could for my clients, making this opportunity the centerpiece of my pitches to potential investors. It felt like one of those rare, almost mythical opportunities Shakespeare alluded to when he wrote, "There is a tide in the affairs of men which, taken at the flood, leads on to fortune." During those exhilarating years, when my hopes soared and my financial standing was still in its infancy, I clung to these words, using them to fortify my resolve. Contrary Yet correct, investment literature is full of praise for the power of contrary opinions. But let's be clear, being contrary isn't enough. The real challenge lies in ensuring that when you swim against the current, you're absolutely certain you're not just paddling against the tide for the sake of it. Consider the early 20th century, when it became evident that the automobile was set to outshine the streetcar. As the once popular urban railways faced declining stock prices, merely buying streetcar shares out of contrarian zeal could have been a costly mistake. The true opportunity came to those who zigged while the financial crowd zagged, but only if their conviction was backed by solid evidence. In forming my investment strategies, a quirky mix of Shakespearean wisdom and a World War I pop song guided me. Back in 1918, amid the war's fervor, the American public's response was strikingly naive compared to the more somber attitude of World War II. The popular music of the era, full of upbeat war tunes, reflected this innocence. One song from that time, "They're All Out of Step But Jim," captured the spirit of being out of sync with the mainstream. I was keenly aware of the risks of being out of step myself. My early investments in food machinery and other companies were made when their worth was overlooked by the financial community. I could have been wrong, and if the market proved me mistaken, it would be disastrous for both my clients and myself to let strong beliefs tie up capital unprofitably. Thus, while zigging when others zag is a route to potential profit, it's crucial to have a robust quantitative foundation to support your contrarian stance. Only then can you confidently navigate the financial currents. Patience and performance, the 3-year rule. In the world of investments, patience is often the unsung hero. I've adhered to a personal mantra I call the 3-year rule, a principle that demands a long-term perspective on performance. To my clients, I repeat this mantra like a mantra. Assess the value of any investment not after a fleeting month or even a single year, but after a full 3 years. If I fail to deliver significant results by then, they are free to sever ties. Success or failure in the initial stages can be as random as flipping a coin. Only over time does the true picture emerge. This approach has guided my management of individual stocks for years, with only one notable exception. Should I have an unwavering belief in a stock that doesn't deliver by the 3-year mark, I'll part ways with it. If it underperforms for a couple of years but nothing undermines my original conviction, I hold firm. This strategy has stood the test of time and is crucial to understanding long-term investment success. A vivid example of this principle in action began in the latter half of 1955. I invested significantly in 2 companies that were new to me, entities that would soon exemplify the rewards and challenges of defying mainstream financial opinions. This period, from 1955 onwards, heralded what I would term the first golden age of electronic stocks. While I use first deliberately to distinguish it from what I anticipate will be the golden age of semiconductor stocks in the 1980s, the significance of the 1955 era was undeniable. At that time, the financial world was unaware of the impending electronic revolution. Companies like IBM, Texas Instruments, Varian, Litton Industries, and Ampex were on the cusp of extraordinary growth. But in 1955, apart from IBM, these stocks were deemed speculative and unworthy of serious investment by conservative financiers. Nevertheless, sensing an opportunity, I invested in Texas Instruments and Motorola, despite their limited recognition. Texas Instruments has since become a leading semiconductor producer, and Motorola, once a minor player, now competes closely in the same arena. Initially, Motorola's appeal to me was not in its semiconductor potential, but its leadership in mobile communications, an area the financial community undervalued. Over time, Motorola's rise in semiconductors, driven partly by the acquisition of Dr. Daniel Noble, was an unexpected bonus. The early performance of these stocks varied significantly. Texas Instruments quickly appreciated in value, while Motorola languished, trading 5 to 10% below my purchase price. This underperformance led to client frustration, with one referring to it dismissively as "that turkey." Despite the lackluster performance and criticism, I adhered to my 3-year rule. Eventually, as the market recognized Motorola's value, particularly in communications, the stock surged, proving the wisdom of patience. Interestingly, when a large insurance company joined me in investing in Motorola, they faced similar skepticism from their bank, which didn't even categorize Motorola in its portfolio review. Yet 3 years later, Motorola had outperformed every other stock in their portfolio. Had I deviated from my 3-year rule, I might have prematurely sold Motorola and missed out on its eventual triumph. The lesson is clear. True value and performance often require time to reveal themselves. By maintaining a disciplined approach and resisting short-term pressures, one can navigate the unpredictable waters of investing and reap the rewards of patience. Every rule has its exceptions, though they're rare. Have I ever sold a stock simply because it hit the 3-year mark, only to regret it later when the stock skyrocketed? Honestly, only a handful of times. Most often, further research and new insights have reshaped my views on a company, leading me to adjust my strategy. However, in the relatively few instances where I sold solely based on the 3-year rule, I can't recall a single case where subsequent market action made me wish I had held on. Have I ever bent my own 3-year rule? Yes, just once, back in the mid-1970s. 3 years prior, I had bought a significant amount of Rogers Corporation stock. I believed in their promising developments in polymer chemistry and anticipated a steady rise in sales. However, after 3 years, the stock was down, and the company's earnings were sluggish. But this was a situation where I chose to make an exception. The company's president, Norman Greenman, was a key factor. I admired his exceptional talent, unwavering determination, and most importantly, his honesty. He transparently communicated both the bad news and the potential positives, which was rare and valuable to me as an investor. Additionally, Rogers Corporation was investing heavily in a single new product, diverting resources away from other promising innovations. When the decision was made to halt this unfruitful project, it became clear that several other promising developments were on the horizon. Although the stock had fallen to levels that seemed out of sync with its true value, this presented a classic case of market pessimism meeting genuine potential. Ignoring the 3-year rule, I chose to significantly increase my holdings. As often happens, when the turnaround began, it was swift and substantial. The company's earnings improved and continued to grow, leading the stock to rise proportionately. So while exceptions to the rule are rare, they can sometimes prove to be worthwhile. An experiment with market timing. Journey back with me to the 1930s, a time when my investment philosophy was still evolving through a mix of trial and error. As I navigated the world of common stocks, I stumbled upon a curious discovery from my study of the Food Machinery Corporation. This company, with its substantial ties to the fruit and vegetable canning industry, inadvertently taught me a great deal about the fortunes of those canning companies themselves. The industry was notorious for its cycles, buffeted by fluctuating business conditions and unpredictable weather. Given my newfound familiarity with the canning industry, I decided to leverage this knowledge not for long-term investments, as I had with Food Machinery, but through short-term trades in the California Packing Corporation, then the largest fruit and vegetable canner. During the depths of the Great Depression and through the end of the decade, I bought and sold shares of this company on 3 separate occasions, each time securing a profit. At first glance, it seemed like a promising endeavor. However, as I later reviewed my business decisions, it became clear that this short-term trading was not as worthwhile as it seemed. The time and effort spent on these transactions could have been better invested elsewhere. The profits, while real, were insignificant compared to the gains I achieved from long-term investments like Food Machinery. Moreover, witnessing the risks involved in in-and-out trading, where even brilliant investors sometimes faltered, made me realize the inherent dangers of such an approach. By the end of World War II, with my investment philosophy crystallizing, I made a pivotal decision that I consider one of the most valuable of my career: to focus exclusively on achieving substantial long-term gains. This commitment to long-term investing would prove far more rewarding and less risky than the fleeting gains of market timing. reaching for price, foregoing opportunity. During the 1930s, amidst the depths of the Great Depression, I stumbled upon a lesson that has proven invaluable in my journey through the world of investments. My previous failure to capitalize on the Great Bear Market of 1929 had already taught me that having the right forecast is useless unless it leads to decisive action. My initial venture into business, during a time when even small sums of money took on monumental importance, highlighted a particularly stubborn flaw in my approach. I found myself obsessed with negotiating for every fraction of a point, chasing those elusive eighths and quarters. Brokers, who were far more experienced than I, repeatedly assured me that if I believed a stock would substantially increase in value over the years, it was inconsequential whether I bought it at $10 or $10.25. Yet I stubbornly set my limit orders based on arbitrary figures, like $10.12, without any rational justification. It's a habit I soon realized was not unique to me, but common among many investors. The real eye-opener came through a client's mistake. I vividly recall a chance encounter with an important client outside a San Francisco bank. I had just returned from a visit to the Food Machinery Corporation, brimming with excitement about its future. I recommended he purchase more shares, which he agreed with, but insisted on buying only at $33.75, despite the stock closing at $34.50 that day. Despite my urgings to adjust his bid, he stuck to his price. Within weeks, the stock surged over 50%, and he never had another chance to buy at his preferred price. This client's misstep made a lasting impression on me, highlighting my own stubbornness. While I eventually learned to let go of minor price differences when buying, I still struggle with it when selling. Recently, a limit sell order cost me a chance to sell at a better price. The shares I held fell 35% from where I had placed my order, and I only sold part of my position at a price halfway between my limit and the current market value. In the end, the obsession with minor price differences can be a costly mistake, leading to missed opportunities and regret. Chapter 3. The Philosophy Matures. World War II left a surprising imprint on my investment philosophy. By early 1942, I found myself in a role quite foreign to my usual business endeavors, serving as a ground officer in the Army Air Corps. For 3.5 years, my business took a back seat as I performed a variety of tasks for Uncle Sam. Looking back, I often joke that my contribution was significant, although my defense zone encompassed the unlikely territories of Arkansas, Texas, Kansas, and Nebraska, far removed from the battles raging in Europe and the Pacific. In this unexpected detour from civilian life, I found my days fluctuating between intense busyness and lengthy lulls. During the periods of inactivity, I gravitated towards contemplating my future business strategy. I began to question the merit of the quick flip trading approach I had employed with stocks like California Packing. Instead, I sought a more enduring and strategic investment philosophy. This introspection led me to two pivotal conclusions. First, I decided to refocus my business after the war. My pre-war clientele had been a diverse mix, each with distinct objectives. Post-war, I resolved to cater exclusively to a select group of large investors, concentrating on identifying companies poised for substantial long-term growth. For these investors, growth investments offered the most favorable tax advantages. Secondly, I foresaw a burgeoning opportunity in the chemical industry. Upon returning to civilian life, one of my primary tasks was to identify promising chemical companies and make them a cornerstone of my investment strategy. Though my time was not entirely devoted to this endeavor, I dedicated a significant portion of my efforts in the first year to gathering insights from industry experts. Conversations with distributors, university professors, and construction firms involved in chemical plant development provided invaluable knowledge. Combining this with financial analysis, I whittled down the options to 3 promising candidates. By the spring of 1947, I chose Dow Chemical Company as my premier investment. E pluribus unum, the Dow Chemical decision. In In choosing Dow Chemical from the sea of promising chemical firms, the rationale was more than mere numbers. It was an intricate dance of vision and values. I think it's worth dissecting the reasons behind this choice as they embody the essence of the companies I seek to invest in. My interactions with Dow's team revealed a palpable buzz of excitement. Growth was not just an outcome, but a shared belief in an even grander future. One of my favorite questions for top executives is about their biggest long-term challenge. When I posed this to Dow's president, his answer was nothing short of remarkable. He spoke of resisting the shift towards a rigid, military-like structure as the company expanded. Instead, he championed the importance of preserving an informal, unstructured communication culture across various levels and departments, all while avoiding administrative chaos. Dow's approach was also aligned with a philosophy I admired, focusing on chemical product lines where they could achieve true efficiency. They didn't just want to lead, they aimed to stay ahead through continuous innovation and a deep understanding of their products. Equally compelling was their emphasis on the people factor, identifying and nurturing talent, ensuring those with potential had the opportunity to explore roles suited to their unique skills. Despite Dr. Herbert Dow's passing some 17 years prior, his principles remained deeply ingrained in the company's culture. One of his sayings resonated profoundly with me. Never promote someone who hasn't made some bad mistakes, because if you do, you are promoting someone who has never done anything. This perspective, often overlooked by the investment community, frequently unveils extraordinary investment opportunities. In the business realm, significant achievements often require pioneering spirit, where creativity must be tempered with practicality. This is especially true in cutting-edge technological research. Even the most capable teams face failures, and when these lead to sharp declines in earnings, the investment community's knee-jerk reaction is to downgrade the management's quality. This can make shares of exceptional companies look like bargains during such downturns. Conversely, companies that shy away from risks and innovation may appear steady, but often fall short of excellence in a competitive market. Another of Dr. Dow's insights that I apply to investment decisions is, if you can't do a thing better than others are doing it, don't do it at all. In an era of heavy regulation, high taxes, and shifting consumer preferences, I believe the risks of common stock ownership are only justifiable in companies that consistently excel and innovate beyond industry norms. This is especially crucial when inflation pressures profits, making broad profit margins essential for sustaining growth. History versus opportunity. In the annals of business history, there are striking parallels between two critical junctures, the Great Depression and the immediate post-World War II era. Both periods, marked by intense pessimism and economic difficulty, presented unique opportunities for those who had the patience to navigate their uncertainties. During the depths of the Great Depression, stock values plummeted to unprecedented lows, reflecting not only the economic havoc of the time, but also widespread fears about the future of American enterprise itself. Despite these fears, the resilience of the American system prevailed, and those who invested wisely during this bleak period reaped extraordinary rewards as the economy rebounded. Fast forward to the late 1940s and early 1950s, a period when I was restarting my business after a 3.5-year military service. Once again, stock prices were low, despite rising corporate earnings. This time, the investment community was paralyzed by the specter of historical downturns. The Panic of 1873, which followed a period of prosperity, and the Great Depression that followed the 1929 crash. The prevailing sentiment was that a similar catastrophic crash was inevitable, given the enormous costs of World War II and the fears of a new depression. Yet, just as before, this widespread pessimism proved unfounded. The anticipated economic collapse did not materialize. Instead, a curious phenomenon emerged in 1949. It seemed that American businesses were valued more for their liquidation potential than for their operational worth. Stocks of companies poised for closure often soared in value, indicating that the market had misjudged the true strength of American business. As I look back from the cusp of the 1980s, I am struck by how little historical scrutiny has been given to the parallels between the post-World War II period and the present. Today, once again, stocks are trading at historically low levels. While not as cheap as in the immediate aftermath of World War II, when adjusted for replacement value in real dollars, they may be even cheaper than in those previous bargain periods. The pressing question is whether the current worries, be they high energy costs, political instability, or overextended credit, pose a greater threat to future growth than the fears that held back stocks in the past. If these issues are not more daunting than the historical precedents, then the 1980s and beyond could well offer the same rewarding opportunities that characterized the two prior periods of extraordinary value. Lessons from the vintage years. The years between 1954 and 1969 were a golden era for me in the world of business. During this time, my modest stock portfolio outperformed the market considerably. Despite this success, my journey was not without its share of blunders. The key to my successes lay in the careful application of tried-and-true methods, but it was the mistakes that proved to be the most instructive. Each misstep carried its own unique lesson. One of the most embarrassing errors, though not the most financially damaging, stemmed from a careless application of a sound principle. In the early 1960s, I was thriving in various technological sectors: electronics, chemicals, metallurgy, and machinery, but I lacked a stake in the burgeoning pharmaceutical industry. Eager to diversify, I began exploring potential investments in this field. I consulted with a leading medical specialist who was buzzing with excitement about a new drug family being developed by a small Midwestern company. His enthusiasm was contagious, painting a vivid picture of the promising future these drugs could offer. Encouraged by this expert opinion, I spoke with a few company officers and other investment professionals who shared his optimism. However, in my eagerness, I skipped my usual thorough checks, neglecting to consult other drug companies or experts who might have offered a different perspective. It turns out that none of the advocates had conducted a rigorous investigation either. The stock was trading at a premium price, reflecting the anticipated benefits of the new drugs. I decided to invest, only to watch the shares tumble by 20%, then more than 50%. Eventually, the company was sold to a larger pharmaceutical firm at a price well below my purchase price. Even at this reduced price, the acquiring company lost money. The drugs didn't live up to the hype, and management issues at the small company went unnoticed in my hasty evaluation. Had I conducted a more thorough investigation, these flaws would have become apparent. This episode taught me to be especially diligent during prosperous periods. My modest initial investment, driven by caution, helped mitigate the damage. The company's problems surfaced before I could expand my investment, sparing me from a larger loss. As the bull market approached its peak in 1969, another error occurred, influenced by the frenzied psychological climate gripping investors. Technological and scientific stocks, especially smaller ones, were experiencing meteoric rises. The imagination of investors seemed boundless, with many believing that any company linked to the burgeoning computer industry had limitless potential. This enthusiasm extended to scientific and instrument companies as well. Up until then, I had resisted jumping into the high-priced stocks of recently public companies. However, I eventually discovered an equipment firm operating in an exciting new technology frontier, run by a brilliant and honest president. After a lengthy and thoughtful discussion with him, I paced the airport, debating whether to invest at the prevailing market price. Ultimately, I decided to buy. While the company did indeed grow over the years, my mistake was in the price I paid for the shares. Despite the company's respectable growth, I ended up selling my shares years later at a price not much higher than my initial investment. Although I believe I made the right decision to sell when the company's future growth seemed uncertain, earning only a modest profit after holding the shares for years is not an effective strategy for capital growth or inflation protection. The disappointing performance was a result of paying an inflated price, driven by the excitement of the times. These experiences underscore the importance of rigorous due diligence and tempering enthusiasm with careful analysis. Focus on mastery, the power of doing a few things well. In my career, I once fell into the trap of overreaching, driven by a misguided confidence that led to significant financial losses. My error lay in extending my expertise beyond familiar terrain, venturing into industries where my knowledge was superficial at best. I moved away from the industrial markets and cutting-edge tech sectors, where I felt confident in identifying strengths and weaknesses, and into the realm of consumer products, an area where my understanding was limited. In sectors where product differentiation is minimal and market success hinges on shifting consumer tastes and the prowess of advertising, my experience in evaluating high-tech companies proved inadequate. I found that the skills which helped me excel in assessing technological advancements did not necessarily translate to discerning success in real estate ventures or other consumer-focused industries. While some may thrive in diverse investment fields, my experience underscores the importance of recognizing one's own boundaries and concentrating on areas of true competence. A wise analyst understands their limits and focuses on excelling within their realm, tending to their strengths and avoiding the pitfalls of overextension. To sell or to stay, navigating market downturns with confidence. When faced with the potential for a market downturn, should investors offload their prized stocks? This question has sparked fierce debate, and my perspective may seem contrarian to the prevailing wisdom of today's investment community. Currently, many investors adhere to the belief that if a stock has performed well, but a downturn seems imminent, it's prudent to sell and lock in gains. Yet, my approach diverges significantly. Even if a stock appears to be at a temporary peak and a decline seems probable, I often choose to hold on to it if I believe in its long-term prospects. My conviction rests on the principle that exceptional companies, despite short-term fluctuations, can offer substantial future rewards. These companies are rare, and with a solid understanding of investment fundamentals, one can often identify them with about 90% accuracy. Predicting short-term movements of individual stocks is fraught with difficulty. Economic forecasts and predictions about the business cycle are notoriously unreliable. Forecasters often miss the timing and severity of recessions, and stock prices don't always align with the broader economic climate. Market psychology and financial community sentiments can have unpredictable impacts. Given these uncertainties, my belief is that one's ability to forecast short-term movements correctly is no better than 60%, if that. The risk of being wrong about short-term declines, therefore, outweighs the potential benefit of selling. For those seeking substantial long-term gains, the dynamics shift. A well-managed company with solid financial health will weather bear markets without losing its intrinsic value. Historically, exceptional stocks often achieve peaks that far exceed previous highs. Thus, from a risk-reward perspective, holding on to such stocks through temporary dips is more advantageous. In simpler terms, if you're invested in a promising stock, the odds and potential rewards are heavily skewed in favor of holding. Selling a stock and trying to time a re-entry is more likely to result in missed opportunities. Even during significant market drops, the value of holding on to a strong stock is generally maintained, whereas the risk of missing out on future gains by selling prematurely can be substantial. Take, for instance, my experience in 1962 with two major electronics investments. Texas Instruments and a fictitious company, Central California Electronics, had both surged in value. Though I warned clients of potential declines and advised holding through the corrections, the actual drops were more severe than anticipated. Texas Instruments fell 80%, while Central California Electronics dropped nearly 60%. Yet, patience proved rewarding. Texas Instruments eventually soared to new highs, doubling its 1962 peak. Central California Electronics, though struggling, still yielded returns several times the initial investment. The crux of the matter is not merely holding through declines, but also learning from them. My oversight with Central California Electronics was not in holding, but in failing to adequately scrutinize the company's management and broader fundamentals. Upon recognizing this, I redirected investments to other promising companies like Motorola, which subsequently achieved remarkable gains. In essence, the lesson is clear. When you have a stake in a company with genuine long-term promise, enduring short-term volatility is often the better course. The potential rewards from holding through market fluctuations frequently outweigh the benefits of trying to time the market. The perils of the in and out game. A lesson from Texas Instruments and Central California Electronics. The saga of Texas Instruments and Central California Electronics offers a compelling lesson in investment strategy. Back in the summer of 1955, when I first acquired shares of Texas Instruments, it was a classic long-term play. The company's prospects were so promising that I had complete faith in their future performance. True to form, within a year, the stock had doubled in value. Despite this impressive gain, the investors I managed were largely unmoved by the prospect of taking profits, except for one account. This particular account, belonging to individuals accustomed to adjusting their inventory in sync with market cycles, was itching to sell. They were used to capitalizing on market highs by reducing their holdings, with the expectation of buying back at lower prices. When Texas Instruments surged another 25%, netting them a 125% profit, the pressure to sell intensified. They argued, "We agree with your assessment of the company, but we can always repurchase shares at a lower price when the market corrects." Reluctantly, I agreed to a compromise. They could sell part of their holdings, but had to retain a portion. As it turned out, this decision was ill-fated. When the market eventually took a nosedive, and the shares plummeted 80% from their peak, the new low was still nearly 40% higher than the price at which this account had been so eager to sell. This experience underscores a crucial point. After a sharp advance, stocks often seem too expensive to the untrained eye. Investors who sell off their shares merely because they've enjoyed a good run, assuming they can buy them back at a better price later, frequently miss out on significant further gains. The stock's price might look inflated in the short term, but its long-term potential could far exceed initial expectations. In essence, short-term price movements are notoriously unpredictable. The allure of playing the in-and-out game can be strong, but it's the patient, long-term investor who often reaps the greatest rewards. The truly extraordinary profits are generally reserved for those who hold on to their investments through thick and thin, trusting in their fundamental value. The long shadow of dividends. In reflecting on the evolution of my investment philosophy, it's clear that no single event, neither a mistake nor a fortunate break, prompted my current views on dividends. Instead, it's been a slow crystallization of ideas over many years. Initially, I embraced the conventional wisdom of the time, which heralded dividends as a boon for shareholders, something to be celebrated with enthusiasm. However, as I observed companies brimming with innovative potential, yet constrained by limited resources, my perspective began to shift. I saw promising ideas stagnate due to a lack of capital. It became apparent that reinvesting profits into these burgeoning innovations could be more beneficial for some shareholders than receiving immediate dividends. This realization deepened as I recognized the diverse needs of investors. For those relying on dividends to sustain their lifestyle, current payouts might be preferable to future gains. Yet, for investors with excess capital and a longer horizon, reinvesting funds, tax-free, into growth opportunities seemed more advantageous. Post-World War II, as I focused on achieving long-term capital appreciation, the issue of dividends became even clearer. Companies with the greatest growth potential often faced immense pressure to forgo dividends. The costs of developing new products, marketing, and expanding operations required substantial capital. As a result, companies with the most promising growth prospects often had little choice but to retain their earnings. There emerged a natural alignment between firms with abundant investment opportunities and investors seeking high returns with minimal risk, who neither needed current income nor wanted to bear the tax implications of dividends. These investors, I believed, would benefit most from companies that reinvested their earnings rather than paying dividends. Yet, the landscape has evolved. Institutional investors, such as pension funds, now wield significant influence. These entities, enjoying tax-exempt status on dividends, often require companies to pay dividends to attract their investment. In response, many high-growth companies have started issuing modest dividends, while others have drastically reduced their payouts. Today, the ability of a company to wisely reinvest retained earnings has become a key differentiator in evaluating investment opportunities. Consequently, I've come to view dividends as a less critical factor for investors who don't rely on dividend income. Generally, stocks with low or no dividend payouts offer more attractive opportunities. Nevertheless, the prevailing sentiment favoring dividends means that on rare occasions, appealing opportunities still arise among high-dividend companies. Chapter 4. Is the market efficient? By the dawn of the 1970s, my investment philosophy was well settled, sculpted over 40 years of experience. Remarkably, nearly every lesson I've learned, both wise and foolish, during these decades, can be traced back to incidents from this formative period. It's worth noting, though, that my journey hasn't been without its stumbles. Despite my best efforts, I occasionally find myself tripping over the same pitfalls. Yet, in illustrating my points, I often draw on first instances of events, which is why the majority of my examples hail from these earlier decades. There's a fascinating rhythm to these decades. Aside from the 1960s, it seems there's not a single decade without a phase where prevailing sentiment suggested that external forces were so overpowering that even the most astute common stock investments were considered reckless. The 1930s, shaped by the Great Depression, saw this sentiment at its peak. But the 1940s were no different, with fears of Nazi aggression and World War II. The 1950s brought anxiety over a potential new depression, while the 1970s were marked by inflation fears and political turbulence. Yet in hindsight, each of these periods offered incredible investment opportunities. In every decade, there were numerous stocks that, if bought and held, would yield returns of hundreds, if not thousands, of percent. Conversely, stocks that were the darlings of speculative fervor often turned out to be traps for the unwary. These decades share a common thread. The most significant opportunities arose from identifying undervalued situations that the financial community had misjudged. Reflecting on the market's oscillations over the past 50 years and the cyclical waves of public optimism and pessimism, the old French adage, plus ça change, plus c'est la même chose, the more things change, the more they remain the same, seems particularly apt. As we step into the 1980s, with all its challenges and prospects, I am confident that this principle will continue to hold true. The myth of the efficient market. In recent years, there has been a surge of enthusiasm for the idea that markets are perfectly efficient, a notion I find rather dubious. This belief, much like other misguided ideas of the past, could obscure potential opportunities for those who are willing to challenge the status quo. For those unacquainted with the efficient market theory, it's important to clarify that efficient doesn't imply mechanical smoothness or the ability to execute trades swiftly, nor does it refer to the subtle price adjustments that occur as market forces shift. Instead, it posits that at any given moment, market prices reflect all known information about a company. In this view, unless you possess insider information, finding genuine bargains is impossible, because any favorable information is already priced in. If markets were truly as efficient as this theory suggests, stock returns would not exhibit the wide fluctuations they do. I'm not talking about overall market trends, but the significant variations in individual stock performances. If the market were efficient in the way the theory proposes, the analytical framework behind it would have to be fundamentally flawed. Efficient market theory originated from the random walk hypothesis, which found it challenging to identify trading strategies that consistently generated profits after accounting for transaction costs and risks. I agree that short-term trading based on market forecasts is extremely difficult. Perhaps in this narrow sense, the market could be considered efficient. However, most of us are, or should be, investors rather than traders. We should be looking for long-term investment opportunities with exceptional potential and steering clear of those with poor prospects. This has always been the core of my investment philosophy. I maintain that prices are not efficient for the diligent, knowledgeable, long-term investor. To illustrate this, let me share an experience from 1961. While teaching a senior investments course at Stanford University's Graduate School of Business, long before the concept of an efficient market became popular, I aimed to demonstrate to my students how the fluctuations of the overall market paled in comparison to the differences in stock price changes between individual stocks. I divided the class into two groups. The first group analyzed stocks starting with the letter A, while the second group looked at those beginning with T. Each student tracked the performance of 4 stocks from the end of 1956 to October 13, 1961. The results were telling. Despite the Dow Jones averages rising by 41% over this period, 27% of the stocks in the sample showed capital losses. Remarkably, 4% of the stocks had lost more than 50% of their value. Conversely, a quarter of the stocks achieved spectacular gains. To drive the point home, I noted that if someone had invested $10,000 in the top 5 performing stocks, their investment would have grown to $70,260. In contrast, investing the same amount in the 5 worst performing stocks would have reduced it to $3,180. While such extreme results are rare, a skilled investor could still significantly outperform or underperform the market, highlighting the potential for substantial differences based on investment choices. A year and a half later, I repeated this exercise with a different set of stocks. The degree of performance variation was almost identical. This pattern suggests that, while some stock performance differences arise from unforeseen surprises, most can be anticipated in terms of direction and magnitude relative to the market. The lesson here is clear. The notion of a perfectly efficient market may be a fallacy, and recognizing this could uncover valuable opportunities for the astute investor. The Raychem Corporation, a case study in market perception. In light of the evidence presented, it's challenging to sustain the notion that the stock market is efficient, at least when we consider the concept as defined by its staunchest proponents. To illustrate this point, let's delve into a historical snapshot from the early 1970s, focusing on Raychem Corporation, a company that enjoyed considerable prestige and a correspondingly lofty price-earnings ratio. During this period, Raychem shares commanded a high premium, driven by a set of operational philosophies articulated by the company's executive vice president, Robert M. Halperin. Halperin outlined what he termed the 4 cardinal points of Raychem's operational ethos. 1. Complexity over simplicity. Raychem avoided technically simple ventures that could be easily replicated by competitors. 2. Vertical integration. The company was committed to conceiving, manufacturing, and selling its products in-house. 3. Proprietary protection. Projects were pursued only if they offered substantial opportunities for proprietary protection, typically through patents. 4. Market leadership. Raychem sought to dominate its chosen niches, regardless of their size, in new product endeavors. By the mid-1970s, these distinctive strengths had caught the attention of major institutional investors. They removed sizable blocks of Raychem shares from the market, convinced of the company's unique competitive edge and attractiveness. Yet, it was another facet of Raychem that truly captivated these investors, and likely contributed to the company's high price-earnings ratio. Raychem was known for its substantial investment in research and development, which was seen as a key driver of its continued success. The company's ability to deliver a steady stream of innovative products, many of which indirectly competed with existing offerings, bolstered its reputation. These new products often allowed high-cost labor to complete tasks more efficiently, resulting in cost savings that justified higher prices and ensured pleasing profit margins for Raychem. As a result of these factors, by the end of 1975, Raychem's stock price had soared to over $42.50, adjusted for future stock splits, a valuation approximately 25 times the estimated earnings for the fiscal year ending June 30th, 1976. This remarkable high illustrated how perceptions of future growth and innovative strength could significantly influence market valuations, challenging the notion of market efficiency. Raychem dashed expectations and the crash. As June 30th, 1976 drew to a close, Raychem faced two crushing blows that would not only ravage its stock price, but also tarnish its standing in the financial realm. The buzz around the company had been electric, fueled by excitement over their proprietary polymer, Stelan. This cutting-edge material, poised to revolutionize the airplane industry's wire coatings, was supposed to mark a new era for Raychem. It was set to be the company's debut venture into manufacturing original chemicals, rather than relying on external raw materials. Raychem had poured an unprecedented amount of funds into this research, believing that Stelan would navigate the typical learning curve and emerge as a commercial triumph. However, the reality was far from the glowing expectations. In the words of Raychem's management, Stelan was a scientific success, but a commercial failure. Although Stelan outshone competitors in technical superiority, it was overshadowed by more cost-effective alternatives. Acknowledging this, Raychem made the gut-wrenching decision to abandon the product and write off its substantial investment, resulting in a staggering $9.3 million charge against earnings. This drastic move sent the company's earnings plummeting from $7.95 to a mere 8 cents per share, signaling a dramatic loss of confidence among investors. The financial community was reeling not only from the sharp drop in earnings, but also from the erosion of trust in Raychem's research prowess. The natural rule of industrial research, that some projects are destined to fail, was overshadowed by the shock of Stelan's collapse and the accompanying write-off. The stock price took a nosedive, hitting a low of approximately $14 by the end of 1976, about one-third of its previous peak, and lingered at these depressed levels for months. Compounding Raychem's troubles was a major internal upheaval. The company, in its quest for optimal management structures to accommodate its growth, decided to overhaul its divisional organization. Previously structured around manufacturing techniques, the company shifted to a model based on industry served. The timing of this restructuring, coinciding with the Stelan debacle, was far from ideal. The necessary transition period, marked by inefficiencies and adjustments, further dragged down earnings. Despite these hurdles, the restructuring effort ultimately proved less disruptive than anticipated. While the initial fiscal quarter following the change showed significantly reduced earnings, the new structure began to streamline operations and eliminate short-term costs by the second quarter. This realignment, though initially overshadowed by the fallout from Stelan, was a positive sign of Raychem's adaptability and long-term vision. In the wake of Stelan's failure, Raychem found itself in a unique position. The funds and talent freed up from the failed project opened new avenues for research and development. Like flowers blooming after a drought, the company began to thrive with a surge of promising research projects. This resurgence, though initially obscured by the financial setbacks, hinted at a rejuvenated future for Raychem, poised to capitalize on the opportunities that lay ahead. Raychem and the enigma of the efficient market. What does Raychem's saga have to do with the burgeoning theory of an efficient market that has recently captivated the financial world? According to this theory, stock prices should instantly and accurately reflect all available information about a company. This means that only those with illicit, inside information would have an edge in predicting a stock's future. In the case of Raychem, the company's management was remarkably transparent. Whenever asked, they promptly shared every detail about the company's situation, including their views on why a period of poor earnings was expected to be temporary. In a striking demonstration of openness, on January 26, 1978, Raychem held an extensive one-day briefing at their headquarters. I had the privilege of attending this session, where the 10 most senior Raychem executives laid out their company's prospects, challenges, and current status with an unprecedented level of candor. They invited representatives from all institutions, brokerage houses, and investment advisors who had, or might have, an interest in Raychem. despite this frank and detailed exposition, the immediate aftermath saw little movement in Raychem's stock price. While some attendees were clearly impressed, many remained skeptical, still haunted by past shocks. This skepticism illustrates a key flaw in the efficient market theory. The market did not immediately reflect the new information provided. So, what can investors glean from Raychem's experience? Those who have embraced the efficient market theory tend to fall into two categories: academic students with limited practical experience, and many managers of large institutional funds. The average individual investor, however, seems to have paid less attention to this theory. From my own investment journey, particularly with technological stocks, the lesson is clear as the 1970s come to a close. There are likely to be more lucrative opportunities among larger companies, where institutional investors dominate, than among smaller tech firms, where individual investors have a greater impact. Just as 10 years earlier, discerning investors who saw through the flawed concepts of the two-tier market reaped the rewards. So too will future opportunities arise from recognizing and understanding the errors in prevailing investment theories. Conclusion: the essence of a timeless investment philosophy. After half a century navigating the labyrinthine world of business, my investment philosophy has crystallized into a series of 8 guiding principles. These aren't just rules. They're the distillation of countless experiences and lessons learned. Here's a snapshot of my approach. 1. Invest in visionary companies. Seek out firms with well-crafted plans for substantial long-term profit growth and robust barriers to entry. The intricacies involved in selecting such companies are too detailed for a single monograph. For a deeper dive, the first 3 chapters of Conservative Investors Sleep Well offer a concise overview with additional insights in the appendix. 2. Capitalize on market missteps. Purchase shares when they're undervalued, either due to broader market trends or current misconceptions about the company's true worth. The goal is to buy low, understanding that true value may not be recognized until later. 3. Hold for the long haul. Retain your investment until there's a fundamental shift in the company's nature or its growth trajectory aligns with the broader economy. Avoid selling based on speculative forecasts. Focus instead on the company's intrinsic qualities and growth prospects. If management doesn't evolve with the company's expansion, it might be time to reconsider your position. 4. Prioritize capital appreciation over dividends. For those aiming for significant capital gains, dividends should be secondary. The most promising opportunities often lie in companies with low or no dividend payouts, rather than those distributing a large percentage of their profits. 5. Embrace the learning curve. Mistakes are an inevitable part of investing for major gains, just as bad loans are in lending. Recognize errors swiftly, understand their causes, and avoid repeating them. Smart investing means cutting losses early and allowing profitable investments to grow. Avoid the temptation to cash in on profits prematurely. 6. Concentrate on excellence. There are only a handful of truly exceptional companies. When they are available at attractive prices, seize the opportunity with both hands. Concentrate your investments in these prime opportunities, diversifying carefully among various industries for larger companies. For smaller ventures, a broader diversification may be necessary. Typically, holding 10 to 12 stocks is more effective than managing over 20. 7. Balance conventional wisdom with independent judgment. Success in investing requires more than just following the herd or opposing it for the sake of contrariness. It demands deep knowledge, sound judgment, and the courage to make decisions that may go against the grain of prevailing opinions. 8. Combine effort, intelligence, and integrity. Success in stock management, like any other field, relies on a blend of diligence, intelligence, and honesty. While we may start with varying degrees of these traits, we can always enhance them through disciplined effort and dedication. Though luck will always play a role in investment, long-term success hinges on skill and the consistent application of these principles. Adhering to these 8 guidelines will pave the way for those who, through perseverance and discipline, strive to shape their own prosperous future. Appendix: Key factors in evaluating promising firms. In my investment philosophy, I prioritize quality over quantity. Rather than spreading resources thinly across numerous opportunities, I focus on a select few firms that exhibit exceptional promise. My goal is to identify companies with substantial growth potential, but also to carefully manage and mitigate risk. To achieve this, I delve deeply into various facets of potential investments, seeking to uncover signs of robust profitability and sound management. It's not just about finding a company with promising prospects. It's also about ensuring that its management team possesses the acumen to realize those prospects and navigate any challenges that may arise. In the following sections, I've outlined the key defensive characteristics I look for when evaluating companies that meet my high standards of promise. This involves a rigorous process of financial analysis, interviews with management, and consultations with industry experts to ensure a comprehensive understanding of each firm's potential and pitfalls. Functional factors for a firm's success. To thrive in a competitive market, a firm must excel in several critical areas. 1. Cost leadership and profitability. The firm must be among the lowest cost producers of its goods or services compared to its competitors and pledge to maintain this advantage. Being a low-cost producer helps the firm weather market downturns and capitalize on opportunities as weaker competitors exit the market. 2. Profit margin and financial strength. Achieving a higher than average profit margin allows the firm to generate substantial internal funds. This financial strength supports growth with less reliance on equity sales or excessive fixed income financing. 3. Customer orientation. A firm must be highly attuned to evolving customer needs and preferences, responding swiftly and effectively. This responsiveness helps the firm continuously introduce innovative products, offsetting the decline of mature or obsolete lines. 4. Effective marketing. Understanding what customers want is crucial, but so is communicating this effectively through advertising, sales, or other channels. Close monitoring of marketing costs and effectiveness ensures that efforts align with customer expectations. 5. Research and development. Even non-technical firms need a robust research capability to innovate and improve products or services. Productive research relies on market and profit awareness and the ability to assemble talented teams that work cohesively. 6. Financial management. A strong financial team provides several advantages. Cost information. Accurate cost data enables management to focus on the most profitable products. Cost control. Effective cost systems highlight inefficiencies in production, marketing, and research. Capital conservation. Strict control over fixed and working capital investments conserves resources. Early warning systems. A critical finance function is to foresee potential threats to profitability and devise strategies to mitigate risks before they impact the business. By mastering these functional factors, a firm can not only survive but thrive, positioning itself for long-term success and resilience in a dynamic market environment. People factors. The secret to business success. For a firm to truly excel, it needs a leader with a blend of entrepreneurial drive, original ideas, and the expertise to turn visions into reality. This dynamic individual must not only inspire but also assemble an exceptionally skilled team, delegating authority wisely to keep the firm's operations running smoothly. The essence of teamwork here is constructive collaboration, not internal power struggles. Attracting and nurturing top-notch managers is crucial, with a focus on promoting talent from within. The need to hire an outsider for the chief executive role can signal underlying issues. A firm where the entrepreneurial spirit is alive and well often showcases unique traits and effective practices that set it apart. This distinctiveness is a positive attribute, not a flaw. Management must stay attuned to the fast-evolving business landscape, continuously re-evaluating established methods and seeking innovative approaches. Embracing change involves calculated risks, but these should be well understood and managed. It's vital for employees at all levels to feel that their workplace is genuinely positive and supportive. Ensuring reasonable dignity and decency, along with a motivational work environment and benefits, is essential. Open channels for expressing grievances and participatory programs can foster a culture of engagement and idea generation. Finally, growth often requires sacrificing short-term profits to build a stronger foundation for future success. Management must embrace this discipline, recognizing that it's a key part of achieving long-term prosperity. Business characteristics. In the world of investment, managers often fixate on the return on assets to gauge the profitability of their ventures. However, investors should be wary of relying too heavily on historic asset values, as they can obscure true performance comparisons between firms. Instead, focusing on profit-to-sales ratios, even when turnover ratios differ, might provide a clearer picture of investment safety, especially in times of inflation. High profit margins can act like a magnet, drawing in competitors and gradually eroding profit opportunities. To ward off this competitive threat, firms should strive for operational excellence to the point where new entrants find no appealing opportunity to challenge them. Yet the pursuit of efficiency often encounters a stumbling block: bureaucratic layers within middle management that can stymie scale efficiencies. Nevertheless, a well-run company that leads its industry can offer a compelling investment due to its robust competitive edge. Being a pioneer in a new market can provide a significant advantage. Certain companies are inherently better equipped to seize this first-mover advantage. However, products don't exist in isolation. They vie indirectly for consumer dollars. Thus, even well-managed, low-cost companies may face challenges if their prices shift unfavorably or if competitors offer more compelling alternatives. Entering a market dominated by established competitors poses its own set of hurdles. While a new player is building its production capacity and market presence, incumbents have the upper hand to implement defensive strategies and maintain their dominance. Success often hinges on how innovators can merge various technological disciplines, such as electronics with nuclear technology, in innovative ways that set them apart from existing competitors. Technology is just one path to industry leadership. Building a strong consumer franchise or excelling in service are other viable strategies. Regardless of the approach, having the capability to defend established markets against new threats is crucial for securing a sound investment.